GETCRACK. Wake up, motherfucker.
Sir?
Welcome back to Squawk Box. Amazon holding the line on its new 5-day per week in-office policy. Company's cloud chief, Matt Garman, saying during an all-hands meeting that staffers who don't agree with the policy, well, they can leave. According to the transcript that was viewed by CNBC, he said the following, in quotes, if there are people who just don't work well in that environment and don't want to, that is okay. There are other companies around. So you've got the message, folks. Garman said he's been speaking with employees, and 9 out of 10, he said, of the people he believes were excited about the change. When asked for comment, a spokesman telling CNBC that, quote, Amazon has observed that working in office helps teams be more collaborative and effective.
Look, I think the other issue is when part of the team's in office and part of them aren't, the people who are in office probably feel like they are carrying a much heavier load. They're the ones who are chipping in and helping out on projects. They're the ones who are doing things that are there behind the scenes and feel like they are carrying a much heavier burden than others. So I think it's problematic to have some people in office, some not. And this is kind of how it plays out. I've been thinking for a long time that when the economy turned down, you would see far more leaders who step up and say, take it or leave it.
Right.
We're not in a down economy yet, but you are starting to see leaders speak up.
Pandemic's over. Let's go. That's LFG.
The only thing that I think is worth pointing out is that, and you can say that they're academics and maybe you don't care, but the science behind this, those who've done the Adam Grants of the world, who have done lots of experiments on productivity and the like, will tell you.
Sounds like a social science.
I know that's why you don't believe in it. But
Exactly.
I'm saying they will tell you over and over again that the science is actually at odds with this and at odds with that.
The way science has been hijacked from the left, I don't even believe regular science.
I know you don't
anymore.
I know you don't believe science, but I think the suggestion is that
I get more science than you ever have in your life.
That sort of a hybrid style environment where there's what's called deep work, where people can do that at home and be more effective.
Depends on what the jobs are. It depends on what your job is. It depends on what the company is.
But that's part of what the debate is, because when you decide that you're going to have these policies that are for everybody, and it doesn't matter who you are or what you do, and the truth is that what's also a fallacy about this is that there are lots of people. By the way, typically the
I'd be happy if I didn't have to come here today.
But the rainmakers, the folks who are actually that are doing...
People who consider themselves rainmakers.
Well, no, not considered. I'm saying that the company rainmakers who are actually bringing in the income typically for these companies are often not in the office because they have to, because they're in the sales business. So
that makes sense.
But this is the point, though. But everybody's job is going to be different. And so the question is, does it all, this sort of like, it all fits in the same boat? I'm not sure.
I think you're always going to have people who get special exemptions.
But it's not even special exemptions. It's everybody has a different type of job. That's the...
Right back.
This Halloween, it's time to turn up the heat and bring those spooky vibes. The John Galt YouTube channel is hosting the ultimate sexy Halloween costume contest, and you could win over $300 in cash. That's right, first place takes home the biggest prize. But don't worry, second and third place will still score big. It's easy to enter. Dress to impress, flaunt your most creative, sexy, or daring costume, and show up to the live stream during the evening of October 31st, which is a Thursday. Come on over on Halloween and flaunt your very best and enter your chance to win the grand prize. Let your imagination run wild. You can be a witch, a vampire, a ghost, a nurse, a cheerleader, anything goes. The more unique and bold, the better. Winners will be crowned based on creativity, style, and those spooky Halloween vibes. The John Galt community will decide who takes home the glory. So what are you waiting for? Get your costumes ready now and come on over to win that prize on the John Galt YouTube channel. Hit that subscribe button, follow the contest rules, and you could be walking away with cash and bragging rights. This Halloween is not just about tricks and treats. It's about winning big on the YouTube channel, The Urban Landlord. It's the only place doing this. Let's have some fun. Let's have
30-day notice, according to a November 15th, a 14-day period of cutback. On November 15th, a 14-day period of cutbacks begins for Intel employees in Washington County. They're getting either a 4-week or 60-day notice, according to a WARN notice posted Tuesday. In a statement, Intel wrote, as part of the broad-based cost savings plan we announced in August, we are making the hard but necessary decisions to reduce the size of our workforce. It goes on to call these the most difficult decisions they ever make, and that they're treating people with care and respect. Long term, they're hoping to become, quote, leaner, simpler, and more agile a company. Back in August, after reporting a $1.6 billion second quarter loss, CEO Pat Gelsinger said in a memo to staff the company plans to save $10 billion in 2025 by making these cuts. Cuts that follow a struggle to keep up with competitors, especially when it comes to incorporating AI into chips.
The Intel layoffs also come alongside an influx of money this year from the federal government to make semiconductors or chips here in Oregon. The Technology Association of Oregon, a nonprofit which supports tech companies throughout the state, told us they'll be focused on helping connect those recently laid off to David, opportunities locally. David?
Thanks, Alma. Appreciate that update.
What's up, guys? So we got a little bit of teaser there. We got a little teaser of what's to come. Intel will report earnings, I believe, near Halloween, and Boeing will report next week. We mentioned it last stream. Those are two big blue chip stocks that could be ripe to buy. I'm not sure, because it could very well be that they do bad news. Everyone expects bad news, but then the stock just rallies anyway, and that was the bottom. Or it's really, really bad news. They didn't expect it. Those two stocks crash right into elections. And if the timing is right, you got all those high big tech earnings with Google, Microsoft, Apple, all of them reporting around the same time in Halloween. Starts a little panic into elections. Then elections, you get a little panicky too, because I'm sure the media will say like, oh, maybe we're not sure who's going to win, this and that, cause a little uncertainty in the markets. Have a little panic before Jerome Powell speaks 2 days after elections. Then we swoop in and buy. So prepare yourselves. It's going to get very busy in the last week of October into the first week of November. That is where we're going to strike for any long-term investing opportunities. So I think that's when these streams will be more frequent. We're going to have dedicated times when I'm coming on here to update you guys. So we'll have a strict schedule that I have to keep. And from there on, yeah, we go from there. So I'm going to read this article first. It's a very good article because I follow this guy. This is a macro investor type, used to work in a hedge fund, named Russell Clark. He has a blog and Substack that you have to pay money, for a paywall. But some articles are free. I don't think you need to pay him anything, though, because I'll just tell you the gist of his thesis. Yeah, what's up, tough guy? Yes. So this is a real key ratio. So I was talking about ratios maybe 2 weeks ago, secondary indicators. And there's a ratio that he likes to follow, gold over TLT, TLT being U.S. Treasuries, bonds that are long duration, 20-year to 30-year. So I've been talking about TLT a little bit too. But gold today popped on the China GDP numbers last night. Perfect. And what's even better, silver really exploded, up 6%. So if you were listening to me, you got into silver miners like EXK, and you got into the gold miners with GDX, or if you're doing more extreme leverage, GDXU. Now, if you missed the boat, don't worry. Don't worry. We're still in the early days. Early days. But let's just read this article for a bit. GLD over TLT has carved out a new high in recent days, which is pleasing. Yes, very pleasing for him because that's his thesis. His thesis essentially says that gold is going to outperform bonds. And, that's not a hard thesis to believe because I'll pull up a chart later. Gold over TLT has always been outperforming since the late teens, aughts. They say aughts. I think it's teens. No, it's teens, right? Teens, not aughts. Teens. So 2018, something around there. And then it really accelerated after COVID. Really accelerated, right? Because what that's telling you is inflation is going to stay. It's going to really stay. And that means bond interest rates are going to stay high. We're not going to go back to that QE bullshit that we did since 2007, 2008. And also, it could mean that, hey, we could have future problems with those countries that want to get away from the US dollar, which I haven't talked about on these streams yet, but I did start when I came on John Galt's channel. That was one of the first things I talked about was the dollar milkshake theory. So I'll come back to that some other time. Not tonight. We got too many articles. But this is where we're going to start with. You look at this chart here. Very nice. See, it's going up. So gold is definitely outperforming long U.S. treasuries, long bonds. The original idea behind gold over TLT is that in a world where governments are becoming more populist, i.e., more concerned with raising wages rather than asset prices. So that's key too. We have a populist type agenda going. So you go with the Democrats, Republicans, or you look around the world, they're all kind of populist, right? You got that Bernie Sanders types on the left. You got the more extreme MAGA types on the right. And in any case, you remember the strikes we had with the port. They backed down and they gave them their raises temporarily for now, right? Because they still haven't settled the contract. But until elections are over, they let them have their wages be raised. Okay, so if this is true, then inflation will be entrenched and central banks will need run much tighter monetary policy to keep inflation under control. So the rates are going to stay high. I think Master Kim brought on a friend who did the capital equipment loans and stuff like that. And he was in the opinion of that notion that rates are not coming back down. Like this is going to stay. So there are people that believe that. I can't say either way. I'm still neutral on this, but bear with me. Let's say this is true. All right. This year has really been the year of gold, as Western central banks have really wanted to cut interest rates. Okay, so you see gold, very nice. Why the Federal Reserve wants to cut interest rates when house prices are pushing higher from already high levels is a mystery. The decision making and the thought process of Federal Reserve governors is extremely poor for people with that much power. It is pretty much guaranteed that once the Fed governors leave office, no one will have any interest in their ideas. Their power comes from their institutional political power, not their inherent intelligence. They are not Friedman, Hayek, or Keynes. All right, that's pretty damning. That's pretty damning. Let me zoom in. Okay. Okay, let's see. This is the house price index. As you can see, house prices are going up. And I believe I showed at one point house prices in terms of gold. So ounces of gold. So how many ounces of gold would you need to buy a house now versus like several years ago or decades ago? Hasn't changed much, actually. So this chart might actually be a reflection of your diminishing power in dollars, right? That's inflation. And I think another chart with the M2 I can present later when I play another video for you guys. For various reasons, the market had convinced themselves that long-term US rates had found a bottom. TLT has been in a range for a year now. Yes, TLT right here. And it's been in a range probably since 2022. So it's over a year. Looks like it's going nowhere, right? What remains most striking was the sheer amount of investment that has gone into TLT, while gold flows have remained fairly stagnant. As I have mentioned, ETF flows usually follow performance. Okay, this is going to be important. This is going to be important. I think I mentioned this last time about like how many people are concentrated in ETFs. So he's talking about the flows. That means how many people are buying that ETF, and it will just be influencing what those ETFs will buy when they get more and more consumer retail type investors coming in to buy, right? This way. Because real institutional investors usually would not touch TLT. They would buy bonds directly from the government. So the only reason TLT has this kind of flow, yes, that means this is retail money. This is not the smart money institution, guys. But for some reason, people have convinced themselves that low interest rates are here forever. So retail guys, right? They are jumping into bonds. So what's this showing? What this graph is showing is that there's a lot more shares of TLTs being printed because there's more demand for this bond. I mean, this ETF. Sorry, my bad. ETF. Gold, however, pretty steady. That's a good sign. Usually when you see a bunch of idiots buy gold, I wouldn't trust them. That means that's not a real move. So commodities, usually when they go up real good, they'll just crash just as fast. But here, this is very nice because that means gold has a lot of room to maneuver next year. A much more typical example is China, where recent surge in shares has also seen a recent surge in shares outstanding for FXI, I mean. So I talked about FXI, right? When China did stimulus, I talked about that ETF. So very nice here. I think this is shares outstanding, right? Ooh, yes. So this was following that announcement that they were having stimulus. You can see like the curve right here, like it was dipping right into the announcement. So that means like a lot of idiots were probably thinking like, oh yeah, I don't need this at all, and then pop, it just pumps up. Very good, very good. So you can see like the retail doing the opposite of what's going to happen. So if they were suspecting that there was going to be a stimulus and FXI jumped up, I think nearly 100%, maybe over 100% at one point during that 2 weeks. Yeah, they would have been buying, but they didn't. They were getting out. They were giving up on it. There you go. From a market perspective, the strength of the Chinese yuan, so that's their currency, is probably the most inflationary signal out there. Okay. Okay, so that's the Chinese yuan. So it's 7 RMB for $1, I think. Is that what it is? Is that right? Yeah, maybe I gotta go find the conversion today. How is it today? Yeah, it's like 14 cents to a yuan. So yes. So that means it's $7 US to a yuan. Okay, there we go. I always get like confused when I do currencies. Yeah, 7 yuan to $1. What's up, Portia? Yeah. So that's good enough. My guess is that inflation trades, such as TLT, are now in the firing line of the market, even with the recent rate cut. Short TLT generates a positive carry. Okay, I'm not gonna get into carry. Like, oh, that's too much of an advanced topic, because I kind of talked about it when we were talking about the yen carry trade. No, not getting into that right now. Yeah, the yield's going up. Yield's going up. That's not bad. It's not bad for bonds right now. You see, I think it hit maybe close to 4% at one point. So FYI, you can buy these bonds. You can get your yield. You can also buy the leverage ETF of TLT 3 times, which is TMF, and you'll also get the same yield. So yes, both those ETFs you can get a dividend that's based on the interest rate, but you won't get your tax benefits though doing that. If you're in a blue state, like I would keep reminding people, you're in a blue state that has high income tax, state income tax, and you're buying a lot of bonds, so you probably have $500,000, like even $250,000 worth of a bond that's paying 3% a year. Yeah, and your income's really high. Yeah, you should probably not do this. Like buy an ETF. You should be buying directly from Treasury Direct and get your interest that way, so you can deduct it from your state income tax. Okay. The JGB market, so that's the Japanese bond market, has also stayed quiet in a quiet bear market, even with the Federal Reserve rate cut and the recent strength of the yen. Okay, so these are the JGBs. These are 30-year Japanese bonds. So here is the trillion-dollar question. Was the Federal Reserve rate increases only deflationary for Chinese assets? Was the pressure that it put on the Chinese yuan leading to weakness in the Chinese property market? The original idea of needing asset price weakness to keep inflation in check was correct, but only in terms of Chinese asset prices. Given the size of the Chinese economy and property market, this could well be true. So we see the property prices in China, and this is when they started trying to pop their bubble around late 2021 into early 2022. You can see that it's trying to go back down, but yeah, still quite high. If that was so, then rising Chinese equities would also would indicate rising inflation and a possible tightening of interest rates in the U.S., meaning inflation in China leads to tighter monetary policy elsewhere. Okay. I remember one guy asked me on John's stream, on the 24-hour stream, why should they give a crap about looking at China? China stimulates, that causes a pulse, an impulse effect. So that's called a credit impulse, and that just sends it all the way to across the world. And I think I probably covered it in detail some streams ago. I forgot. I'll have to look back and see what I said, but I covered several articles on it, and it's happening again. It's starting to happen again. Oh yeah. Hi. What's up, J Rillo? What's up, J Rillo? We are already seeing signs of this with currencies like the Korean won weakening on Friday, pricing in potential Federal Reserve rate hikes. That's interesting. Now, this article was written October 7th, so keep that in mind. It was quite a while ago. And since they talk about the Korean won, it reminds me of the fact that you look at the export data, so how much Koreans are exporting as a leading indicator of how well the global economy is doing. So if Korea is exporting a lot of your Samsung phones, the Samsung also builds refrigerators and washing machines, and they also build chips. They also build memory chips. So if you see a lot of demand from Korea, it's really easy to tell that the global economy is doing well for some reason. Is it because it's a small country that exports a lot, and that's why it's a good way to tell? I'm not sure, but keep that in mind as well. Korea exports. That's always looking at a leading indicator for how well the global economy will do. And I think, yes, when you look at their currency, also that reflects it. If the currency is very strong, then you would say like, yes, there's a lot of good in the global economy. If it starts dropping, then you think like everything's gone to shit. So stuff like that. It is an interesting idea and a long way of saying that I think TLT is likely to weaken from here, and gold could well take a rest. So that's it. That's the whole article. And there's these comments here. I think you can read some of them yourself. But a lot of this is like, theory, right? That's why I don't like to listen to a lot of macro guys too much. They fall in love with their theories a lot of times, and so they're biased. I try not to take any viewpoint. I'll keep my mind open as much as I can. When you're a trader, all you care about is, okay, look at the chart. What is the chart telling me? That's it. Just give me the data, and then I'll draw my conclusions for there. And anything I think about before, I'll always change my mind quickly if I'm going to be wrong. Yeah. Let's see. Jay asks, how bad are the taxes on international stocks when you sell? Can be much better than our own. It's taxed twice. Ooh, I don't play around with too many international stocks where you have to take into account that issue. And I know some of them can be quite painful. I'm in one right now. Well, it's not international in the sense that the stock trades in the US market, but their dividends are taxed with Israeli tax and then our tax. So yes. So if you're thinking about dividends, definitely look into those things. As far as international stocks, like if you buy a stock that's traded internationally, then that's bad. But if you're trading like a Chinese ADR, you don't have to worry about that. So as long as you're trading something that's traded on US markets, OTC, over the counter, NYSE, New York Stock Exchange, NASDAQ, you don't have to worry about this. But if you are actually owning stocks that are domiciled elsewhere, yeah, you got issues like that. Or you have a dividend issue like I may have to do, because that depends on if I hold that stock when they issue its dividend. Okay, so I mean that's just a problem with your CPA. He'll have to figure that out. But I think most stocks you can find equivalents in the US, and if you can't, usually people just trade ETFs then, because then they could hide it. And the same thing with gold and silver. Gold and silver is a collectible tax. So I told people to, if you're gonna use paper, gold and silver, either you trade futures, which are taxed with 60% long term, 40% short term, meaning it doesn't matter how long you own a futures and you trade it for like a millisecond, 60% of those gains are taxed long term capital gains, 40 is short term with futures. Or if you paper trade with ETFs, then on gold and silver, then you use the Sprott ETFs, SPROTT, look it up, and follow the rules of how to file your taxes correctly. But you will buy PHYS, Fizz. So I'll put in chat Fizz for gold, and PSIL, so PSLV, PSILV for silver. That's what HB is going to play with. I mean, that's only if you care about holding it long term. If you do short term, I don't believe it helps in any case. The short term rules take over, and you don't need to fill out that weird form, worksheet, whatever in the IRS, blah, blah, blah. Yeah, I'm not a tax person, so don't rely on me for that. I just have an overview idea of taxes, but so talk to your professionals. But yes, this might be more obscure when you're talking about international stocks. But I do know the forms. I've seen them before, but I never had to deal with it. So that the Sprott ETFs, yes, they'll protect you from that evil long-term collectibles trading tax rate, which is quite high. I believe it's at least 45%. Art, Pokemon cards, baseball cards, your Funko Pops. If you got Funko Pops you want to sell, and the IRS knows that I mean, honestly, a lot of that stuff, you can, if you deal in cash, nobody has, there's no paper trail, but when you yes, I mean, if you sell gold bars and stuff to someone, I mean, as long as they don't report it, like, who knows, right? But uh for from what I could tell you is, if you want to buy physical and sell physical gold, it's easy to get around that, because Chinese and Vietnamese jewelry stores, they'll take your gold. You can buy gold from them. They're not going to report it as long as you just pay in cash. You got the cash, no problem. They don't do silver. I don't think they liked it. I never seen people rush in there to buy and sell silver in those jewelry stores. The Asians just love gold. Indians, right, too, right? But I don't know if I've ever seen an Indian jewelry store and around the U.S. But I'm not in an area where there's a lot of Indians, so I couldn't tell. There's more influx of Indians all the time, so maybe they'll open one and I'll check it out. But silver, I'm not sure. So it's mostly American collectible stores, and I'm not sure if they report it to the IRS. I mean, I'm assuming more likely Americans will try to stay on the nice side of the government, so they'll report it. But yeah, you gotta find someone, right, to trade your gold and silver if you need the cash, and make sure they don't snitch to the IRS. But I didn't tell you that. I did not tell you that. Remember those last time? I have both already on my watch list. Yes, that's right, Jay Willow. But in any case, let's continue on. So, like I said, this is a theoretical exercise. Most of these people who do macro analysis, they tend to fall in love with their idea. But I do like this idea because the charts, as he's shown, proves it out. Okay, I think that's the main article I want to read today, and I have other ones about China, I think, and Japan. I think only Japan. I'm not going to talk about China's GDP really, but I'll just talk about their report here from last night. So Japan had the inflation rate, so it had a drop, and that's not good. Japan actually wants inflation because they've been in a deflationary cycle for so long. They want to make sure inflation stays up. So the opposite problem with the rest of the developed Western world and developing world, the developing world has quite a bit more inflation. Look at Brazil. Argentina is a big one. Turkey, very nasty inflation. Turkey just finally dropped to 50% inflation year over year. Crazy inflation there. And Mexico, I think, is still around high fours. It could be still at 5%. I don't know, but it's quite high. So the annual inflation rate in Japan fell to 2.5% in September 2024 from 3% in the prior month, making the lowest reading since April. Electricity prices increased the least in 3 months as the impact of energy subsidy removal in May waned. Okay. So cost of gas rose much more slowly. 7.7 versus 11%. More of a cost, moderate for food. All right. Anything else here? Core inflation rate hit a 5-month low of 2.4%, down from August 2.8% compared to the consensus of 2.3%. Okay. So that's actually not good. Not good. And I'll read an article describing why. But it is good for gold, I think. Japan's core inflation slows on fuel subsidies, demand-driven pressure intact. So this was written in Reuters, October 17th. Okay. Here's a data link there for you guys. Trading Economics. Always use Trading Economics. Has a very nice calendar. And here's a Reuters link for you. Okay. So Japan core inflation slowed in September due to a rollout of energy subsidies, but an index excluding the effect of fuel held steady. Okay, so their own version of the CPI that takes away the fuel, the energy costs, is still staying sticky. So that's a sign that broadening price pressure will keep the central bank on track to raise interest rates further. All right. But here's the problem. A Reuters poll, however, showed inflation in Tokyo seen as a leading indicator of nationwide trends. So they look at the Tokyo specifically, the metro area, to figure out what the rest of Japan's inflation is going to be. So it's likely fell below the Bank of Japan's 2% target in October. Okay. Tepid services inflation also casts doubt on the central bank's view that solid wage growth will support consumption and keep inflation durably around its 2% target. Mm-hmm. The data will be among factors the Bank of Japan will scrutinize in this month's policy meeting when the board releases fresh quarterly growth and price forecasts. Falling global commodity prices and the yen's rise will likely lower food prices down the road, said Junichi Makino, chief economist at SMBC Nikko Securities. Services inflation as a whole will continue to stagnate. So this is a different problem than what we have. The US has a strong service economy, and it's still quite strong with the PMI data that we've been receiving and what the bank's earnings have shown. And I'll show you that later with the bonds, looking at what the bond market is saying, where the interest rates are going to be. So service inflation on whole will continue to stagnate, he said, predicting nationwide core inflation to fall below 2% in October. Japan's core consumer price index, which includes oil products but excludes fresh food prices, rose 2.4% in September from a year earlier, data showed on Friday, compared with a median market forecast for a 2.3% gain. The slowdown from a 2.8% rise in August was due largely to the government's rollout of temporary subsidies to curb utility bills, which will weigh on inflation in the coming months. So here's a nice plot. This is pretty good. Pretty good plot that you should read. So if you look at the blue line, all items less fresh food and energy is at 2.1%. So it's dropping. Services definitely dropping. Goods is still high, right? Still above 2, but services dropping to below 2, that little light line at the bottom. Yeah. Okay, let's go down here to the near the end of the article. Accordingly, we still expect the Bank of Japan to press ahead with another interest rate hike before year end. Okay. Ueda has said, so Ueda is the BOJ governor, the Bank of Japan governor, has said that the driver inflation must shift to solid domestic demand and wage growth from rising raw material prices for inflation to durably hit 2%. That has put the focus on whether higher wages will prod firms to hike prices for services, particularly in October, when, along with April, many Japanese firms typically revise prices of their goods and services. Nationwide data for September showed service inflation slowed to 1.3% in September from 1.4% in August, backing up the BOJ's view that firms were passing on rising labor costs, but at a feeble pace. Analysts polled by Reuters expect Tokyo core CPI to have risen 1.7% in October from a year earlier, undershooting the BOJ's 2% target for the first time in 5 months. the October Tokyo CPI data, which will come out a week before the BOJ's October 30 to 31 meeting. Oh, another big event for Halloween. So all these crucial things are happening. So why do I give a crap about Japan? I'm telling you, the central banks that matter are the US, Japan, and pretty much China, I think. Yes. So I think those three are the key ones. Now, I didn't talk about the UK or EU. And the reason why is that usually the UK and EU probably don't matter. The UK and EU tend to follow what the US is doing. The Bank of Japan likes to do their own thing. They also like to do surprises. And also, they do currency manipulation when necessary to keep the yen from getting too hot or too cold. So, all these little effects with the yen and the yields of their bonds caused that huge shockwave crash back in August into September. So that's why you have to care. The yen carry trade, all this other stuff, Japan matters. So even if you own a stock in the US and you don't think it matters, it matters. Just like China matters, right? What they do, it affects your commodities market. It'll affect your inflation. It'll affect your food prices eventually. All these things tie together. Because if China's going up, your oil prices is going up, your crude oil prices going up, trucking will costs and expenses will go up, shipping things to your refrigerator into Safeway, all these things, yes, that is going to add up. All of it adds up to your final bill. And it also affects the stock market. As we shall see if I have time today. Another key factor seen determining the BOJ's rate hike timing would be next year's wage negotiations between companies and unions. Same problem we have here, right? And I read that other article earlier about gold over TLT. We're living in a world where there's a lot of labor demands now, and we have elections that are more populist. So the people have more and more sway, in a sense, over how they're going to get their money. And this is going to have an effect on overall inflation. So it's a wage price spiral, as they call it. So that's what they will tell you in economics, a wage price spiral. Another key factor determining, yes, I read that, while many firms are expected to keep hiking pay to attract talent in a tight labor market. So the reason you have some sway is that people are looking for good workers. It's hard to get good workers. That's one big thing. And it's also hard to find cheap labor now too. So both sides of the equation is getting hammered. Some may not repeat the bumper increases offered this year if slowing demand weighs on profits, analysts say. No policy change is expected at the BOJ's October 30th to 31st meeting, though markets are divided on whether the bank could hike rates in December or wait until January. A slim majority of economists polled by Reuters saw the BOJ foregoing a hike this year, with most expecting the central bank to raise rates again by March next year. Okay. That's it for now. Let's see what else we got on the list. Yeah, I'm going to talk more about interest rates later if I got time. That's really what the lesson of the day will try to focus on. So let's move on to TSMC. So we already talked about this during the week, but let me read an article about it just to summarize what happened. TSMC's profit beats estimates during an AI chip boom. The chipmaker reported a 54% rise in quarterly net income. ADRs climb on Robinhood's overnight trading platform. Yes. Let's see, blah, blah, blah. I guess. Okay. The main chip maker to NVIDIA Corp and Apple Incorporated reported September quarter net profit of new Taiwanese dollars 325.3 billion or 10.1 billion US dollars versus an average estimate for 299.3 new Taiwanese dollars billion. That followed a previously reported 39% climb in revenue during the period. TSMC shares have surged more than 70% this year, outpacing many of Asia's biggest tech firms in a reflection of outsized expectations around its AI business. Taiwan's largest company raised its outlook for 2024 revenue in July, underscoring expectations for sustained spending on AI infrastructure from the likes of Microsoft, Amazon. Steady adoption of artificial intelligence should also help fuel sales of iPhones and other gadgets, while official trading for TSMC's ADRs, that's what American Depository Receipts mean. Okay, so that's how you get shares of foreign companies in the US. So that's what Jay Rillo was talking about. Like if you had foreign companies, you don't need to go to Taiwan, buy shares of TSMC, take profits on them, and then have to report it to the IRS here. Okay, so you buy TSMC shares here, ticker symbol TSM. It doesn't matter. Okay, don't worry about Taiwanese tax laws and IRS tax laws and then couple them together and do some weird crap. Don't. As long as you buy it here on an American exchange, you're fine. So it won't begin for a few hours. The ADRs are already up 4.5% on Robinson's overnight trading. It ended about, I think, 5% up, but today it went back down. So today's Friday, it went back down 2%. TSMC is popular among U.S. retail traders seeking to bet on the AI theme. Shares of Japanese chip gear makers, including Laser Tech Corp, pared losses in Tokyo after TSMC reported. So, yeah, this is a chart. You see Samsung has been going down. Actually, Samsung, I think, reported earnings some week ago, a couple weeks ago, maybe. Yeah, hasn't done very well. Still, investors will be watching for deviations in outlook after major supplier ASML Holdings reported only half the orders. Analysts estimate the chip maker gear maker blames slower than expected recovery in automotive, mobile, and PC markets, impacting expansion plans for chip plants. AI remains a bright spot. So that's what we covered last time. I played some of those videos for you. Yes. So let's see. Yeah, I'll read this. TSMC's short to medium term revenue outlook remains solid despite the potential slowdown in global fabrication capacity growth implied by ASML. Its largest tool supplier reporting a Q3 book at half the expected level, so that's quarter three. Strong demand for TSMC's 2 and 3 nanometer technologies from NVIDIA, AMD, Apple, and Qualcomm provide an offset. TSMC's superior production yields, improving EUV machine productivity, and leadership in 2.5D and 3D packaging offer further sales support. I think we should probably talk about China versus Taiwan at some point because so China has to use SMIC based in China, so they're behind. I think they're around 7 nanometer right now, and they need that EUV tech to go further. And the EUV tech is from ASML, and that's one of the reasons why their shares are going down. It's because their exports are being curbed by U.S. Rules and sanctions. So the Dutch company here can't sell to China. Even before ASML, some investors have grown cautious about the sustainability of global AI spending. They question whether big tech firms like Meta Platforms and Alphabet will continue to splash out on AI chips and data centers without a truly killer AI application. So this is a key issue. If you believe that there's going to be a bubble that goes out of hand, because right now it is a bubble, but not to the expectations I would expect a true bubble would have, where it's like the .com days, and that was a really crazy bubble, really crazy. And I'll talk about multiple expansions later. if we have time, and I'll discuss like why would someone buy expensive stocks. It's because you're competing with bonds. And yeah, we'll get to that. We'll get back to that. Especially when I was talking about TLT, right? So TSMC sales have more than doubled since the start of 2020. Okay, very nice. Very nice. So you see this graph here with the revenue, and you got capital expenditures. So how much are they spending on their factories right now? So they're going to spend a lot in their factories into 2025, it looks like. For now, TSMC appears to be pursuing a rapid international expansion. It's planning more plants in Europe with a focus on the market for artificial intelligence chips, according to a senior Taiwanese official. That's on top of construction underway in Japan, Arizona, and Germany. All right. And if we're talking about cloud, let's go to this article. So I mentioned this a few times already, but I'll reiterate it. Amazon signs deals to invest in small modular nuclear reactors. This is October 16th. Oh yeah, let me put up the articles for the TSMC here for you guys. So that's the TSMC one. And here's the Amazon one. There you go. Amazon announced a series of deals Wednesday aimed at building out small modular nuclear reactors, becoming the latest major technology company to invest in nuclear energy as big tech contends with the extensive energy needs of artificial intelligence. As part of an agreement with Energy Northwest, a consortium of public utilities in Washington state, the e-commerce and cloud computing giant will support the construction of 4 small modular reactors. The reactors are expected to initially produce about 320 megawatts of power, with the ability to build additional modules and increase the total capacity to 960 megawatts. Amazon will have the right to purchase electricity from the first 4 reactors. Nuclear is a safe source of carbon-free energy that can help power our operations and meet the growing demands of our customers while helping us progress toward our climate pledge commitment to be net zero carbon across our operations by 2040, said Matt Garman, CEO of Amazon Web Services, in a statement. Amazon is also investing in X Energy, an advanced nuclear reactor and fuel company whose designs will be used in the reactors constructed by Energy Northwest. It anchored a roughly $500 billion fundraising round for X Energy. The company also signed an agreement with Dominion Energy to explore the development of small modular reactors near the company's existing nuclear power station in Virginia. Amazon's announcement comes just 2 days after Google announced a similar deal with Kairos Power to build a fleet of small modular reactors to power the tech giant's data centers. The deals come as major tech firms look for new ways to power the AI boom. The technology requires vast amounts of energy, which in some cases has driven up the firm's emissions. This poses a problem for many tech companies which have vowed to become carbon neutral or negative in the near future. One of the fastest ways to address climate change is by transitioning our society to carbon-free energy sources, and nuclear energy is both carbon-free and able to scale, which is why it's an important area of investment for Amazon. Our agreement will encourage the construction of new nuclear technologies that will generate energy for decades to come. All right, so let me bring up a chart. So, like we were talking about, uranium. Very, very nice looking chart. So, if you didn't buy the dip over August to September, let us look at what can be done. And also look at silver too. Yes, silver, very important. And gold. And gold miners, pretty much. Those are my little babies right now. Okay. So this is uranium. Showed this chart a few times. We're in this rectangle here. I showed this yesterday. And this week we've ended in a nice candle. Very good candle here. Now will it get out? I don't know. It could easily drop back in, and this range can continue for a little bit longer. And it might be, an election thing. Who knows? I don't know. I don't know if uranium really cares about who wins, honestly. But we'll see. We'll see. We'll see if elections for Congress and the president altogether matters for uranium. But this is something we got to watch. And while we're at it, let me check out how some lithium stocks have ended. So this one, LAC, it was up on some news. I forgot what was the news. There was some news on LAC. I keep forgetting what it was. Lithium news. Yeah, it was some GM. They were betting on a new project with them. So they were investing $625 million project. So that's why. But it's mostly has retreated from that. So that pop, yeah, it's pulling back now. So, but you definitely should watch it. And PLL is the other favorite here. It's still dying off. So after the whole Ghana Tesla hype, so it's pulling back now. So yeah, you got to be careful with these guys. Don't just rush in to buy. If you're really trying to do it long term, you gotta be tolerant of how it moves, because these things move very fast, up and down. So you gotta get at the right time, okay? And this guy, ooh, yeah, it's not really ready, but keep an eye on it. Maybe if it gets down to like $9, $9 to $10, I might consider it. But SGML is the one I like to play with. So it's a little bit more stable, right? It doesn't pop up as high, but at least it doesn't crash too much. Maybe when it gets to 11, I'll consider it. So SGML, that's the one. But today is a very good day for silver. So silver miners today was up. I think I sold a chunk when it was at 14% today. It pulled back a little bit now. Ended the day at up 12.47% at just around 4.78. So $4.78. Very close to $5. Once we get to that $5 area, that's great. So that's a silver miner. Very risky silver miner, because you can see how it moves, right? If you bought at this very low level at 1.45, you could have sold it at close to 5 if you were really that good of a trader, I suppose. But let's look at the silver miner ETF, GDX. Very nice. We finally broken out. So this area here wasn't penetrated since August, September 2020. Last time we got close to it was April 2022. Before you saw this huge red candle right there. That's why commodities is a pain in the ass to trade. Very painful. And if you're doing miners, it's not much better. It's even worse, perhaps. So anything mining a commodity, you'll see pain if you're on the wrong side of it. And we've been doing quite well so far. So I think maybe it's a good time to take a break, right? I think gold has risen quite a bit since June. This has been a very nice uptrend. But yeah, you're going to have to take a break for a little while, I think. And silver finally broke out of this little area here. Perfect. Over 33 dollars an ounce. Futures price is 33.97 was the high for futures. Close 33.925. So that's paper silver. Not bad. So we're hitting the targets. Now, copper is still struggling, hasn't really broken out. I still need to see it above £5, $5 a pound for copper. Once we get that, we're good to go. Good to go there. Let me see what else I want to talk about. I think my favorite thing to talk about next is Zim. So I brought up Zim. It was a shipping stock. And when it was going up because of the pending strike, so the East Coast strike, this is a West Coast Israeli company. I mentioned it before. It has dividends, and you got to pay taxes on those dividends to Israel, and then you have to pay it again to the US. Okay. But I bought it around here, 24, right? 24-ish, 23, 24. And then I bought it again at 22 when they got the news that they weren't going to strike. Then it dropped right here, right? 19. So I bought it again. So I'm done buying with this. I'm going to wait and see if we're going to get back above 24 because we're in this nice long range here. And I did my little point and figure chart before a couple weeks ago. And I have to update it because I think now this stock can go up to about $50 a share. Okay. So once it breaks out here, we can get to 50. When we get to 50, we got a clear shot at maybe getting up to these old highs at 90. But we'll see. We'll see if it gets there. I think right now it's really dependent on the China news. So this is the reason it popped, because of all these China news. And I'm going to read some of those reports. So silver and the shipping stock. So all of that is due to the Chinese data overnight. So let me zoom in. The Chinese economy expanded 4.6% year on year in quarter 3 of 2024, compared with market forecasts of 4.5% and a 4.7% rise in Q2. It marked the slowest annual growth rate since Q1 of 2023. Amid persistent property weakness, shaky domestic demand, deflation risks, and trade frictions with the West, the latest figures come as Beijing had intensified stimulus measures to boost economic recovery and rebuild confidence. In September alone, there were some positive signs. Industrial output and retail sales both saw their largest increases in 4 months, and the urban jobless rate fell to a 3-month low of 5.1%. On the trade front, however, exports rose the least in 5 months, while imports were sluggish. In the first 3 quarters of the year, the economy grew by 4.8%, compared with China's full year target of around 5%. During the period, fixed investment rose by 3.4% year on year, topping consensus of 3.3%. So not good, not bad, but nothing surprising there. Now let's see how about industrial production? See what the manufacturing side of China is doing. China's industrial production grew by 5.4% year on year in September 2024, above forecast of 4.6%, and accelerating from August's 5-month low of 4.5%. It was the fastest expansion in industrial output since May, marking the first acceleration in 5 months amid the government's efforts to spur growth. Output growth mostly accelerated in manufacturing and the electricity, heat, gas, and water production and supply sectors, 10.1% versus 6.8% here, while growth in mining remains steady. Within manufacturing, 36 out of 41 major sectors advanced, notably railway, ship, and aviation, up 13.7%, computer and communication up 10.6%, heat production, non-ferrous metal smelting, oh, here we go, up 8.8%, non-ferrous metal smelting. Okay, that's a key. That's a key. We should talk about that, actually. Let me see if I have those articles here about smelting, China, and copper. Yeah, I don't know if I will talk about that. I was going to plan on talk about that today, but I mean, John brought it up to me, and I told him that China is a big manipulator of copper. Okay, here's one article. I'll read this one. So let me put this on the link in the chat for you guys. Because yes, that reminded me. The copper smelting. Replacing China in copper supply chain is unfeasible, warns Woodmac as the West seeks shift. So this is August 16, 2024. A shift by Western economies away from China's copper supply chain could raise costs and delay the energy transition, says Wood Mackenzie. While supply chain risks can be mitigated in various countries, the scale of China's dominance in the downstream supply chain means complete replacement is unfeasible, said the mining expert. Western countries seeking to diversify away from China's dominance in copper could delay the energy transition, blah, blah, blah. That we read that. China leads the world in key segments of the copper supply chain, with the critical metal serving as an important component in emerging technologies such as renewable energy, energy storage, and electric vehicles. As the US, Canada, Australia, and European countries seek to displace the country's hold on copper through subsidies and investment, Wood Mackenzie warns that the dual aims of decarbonization and reduced dependence on Beijing are at odds with one another. Hundreds of billions of dollars in new copper processing and fabrication capacity would be required to replace China, the natural resources data center data analytics firm said a report released on Thursday, adding that demand for the metal could grow by 75% to 56 million tons by 2050. This would create inefficiencies that would result in significantly higher priced finished goods and increase the cost and timeliness of the energy transition. Existing mines and projects under construction will meet only 80% of copper needs by 2030, according to the International Energy Agency, indicating a potential shortage of the metal. According to Wood Mackenzie, most of the world's initial mining of raw materials occurs primarily in the Americas and Africa, with China's domestic mining output constituting just 8% of global production. Ooh. Though that share rises closer to 20% after accounting for China's overseas mining assets, the country will still need to secure additional supplies to meet its needs. The rest of the world has enough primary mine supply to meet current requirements, the report said. The copper supply chain, however, comprises several key phases, including mining, smelting, and refining, fabricating, and the manufacturing of finished goods. And what the rest of the world has in copper mines, it lacks in China's dominance in downstream processing and manufacturing, according to the report. As governments and manufacturers aim to diversify away from China, it is crucial to consider the entire supply chain, not just mining operations, said Nick Pickens, research director of global mining at Wood Mackenzie. While copper supply risks can be mitigated and some rebalancing has begun in various countries, the scale of China's dominance in the supply chain means complete replacement is unfeasible. Look at all that nice copper. Would you like to work there? The report outlines that 80% of copper mining produces copper concentrate, which must be processed at smelters and refineries to produce copper cathode. Fabricators then use the material to make copper components that wind up in finished goods. Since 2000, China has been responsible for 75% of the world's smelter capacity growth, according to Wood Mackenzie's data. A scenario without China for the copper supply chain will require a substantial increase in processing capacity to meet energy transition targets, said Pickens. The report said that there are currently no plans for new primary smelting capacities in North America or Europe. Instead, the U.S. has focused on secondary markets and copper recycling, recently establishing its first secondary smelter for multi-metal recycling in the country. That's interesting. China also accounts for around 80% of additions in copper and copper alloy fabrication capacity globally since 2019, and it now, uh, with it now having half of the world's fabrication capacity, legislations like the Inflation Reduction Act in the U.S. have aimed to subsidize critical mineral investments. However, with copper, such efforts have met hurdles in the US and Europe due to factors such as low utilization, high operating costs, and environmental regulations, the report said. Pragmatism and compromise will be essential to achieve net zero goals without imposing excessive costs on taxpayers. Easing global trade restrictions could be one necessary concession. All right. I think that's it. That's not a bad article. I think it covers a lot of stuff right here. Okay, guys, let's go back to looking at charts for the S&P 500 and NASDAQ before we continue on. So this is QQQ ETF. Go look at the daily. You see here we didn't do much today. It's Friday. Options expired. Nothing shaky, nothing new. Netflix was the big winner. That's why QQQ could hold. Netflix candle looks very nice. I believe this is a new high for Netflix. Yes, yes, yes. Closing at 763 and 89 cents. So it's up 11.09% today. Very good volume. And let me play a video for Netflix because it saved the day. Actually, before I do that, I'll review the S&P 500. SPY closed at 584.59. Futures for E-mini futures S&P 500 5,907.50. So not exactly at the high, but very close to it. So far, I see no problems. But next week, we're going to have some more earnings. So we'll see how that goes. Tesla is a big one. So let me play a video for Netflix. I think I have a couple videos maybe.
Bottom line, they look pretty good to me, Geetha. How'd you see it?
They look very, very good, Romain. And I think the one big thing that, we were looking for was guidance in terms of operating margin. So obviously they raised their guidance for 2024 from 26% operating margin. That was already a 500 basis point increase from the previous year. They raised it now to 27%. But I think what was a little bit disappointing is we're only going to see, they're targeting only about 28% in 2025. So obviously it looks like we've kind of pulled forward some of that operating margin expansion. So that I think is going to be a key focal point going forward. I mean, I'm not sure if they're just being conservative or how to map this out. But I think one thing that, investors were really looking for and didn't get was the announcement on price increases, because now there's less clarity, as you pointed out, into the revenue growth trajectory.
Does that mean it's not going to happen anytime soon, or is this something that in the past they've announced during the earnings call and didn't include in the actual letter to shareholders?
I'm not sure whether they're going to announce it on the earnings call. They're probably working through some more of the different things. I mean, we kind of have to look at the whole change in the narrative now for Netflix. They are going to stop reporting subscribers. So this is going to go from, a subscriber story to a top line story. And as you, pointed out in the segment before, advertising is obviously going to be a big part of that. And how big the advertising portion gets is definitely dependent on how much they are going to raise prices. If they're going to price people out, if they're going to raise the standard plan price from, let's say, $15.50 to $20, that means they're going to drive more people to that ad-based tier. So it's going to be interesting to see how they want to play this. You also pointed out that they have huge pieces of programming coming on in the fourth quarter, all of which play really well to that advertising base. So again, it's probably just a timing issue.
That's a good point. I do want to get your thoughts here on the cost side of the business. When we talk about revenue, the cost of those revenues, at least about 50%, more than 50% of the actual top line number. I know that's been pretty consistent for this company, but when you talk about the amount of content that they have to produce and the amount that they have to pay, Geetha, are you comfortable with that spend?
I definitely have seen a huge, and this has been across the board, Romaine. There has been this huge content cost rationalization, and definitely it's the same for Netflix. We're seeing them take a much more balanced approach towards kind of greenlighting new shows. We're also seeing them kind of really expand their catalog, going into different genres, some of which has happened to be much more cost effective, apart from, of course, the local language programming. But again, we are going to have to see what happens in 2025. As they try to build out this advertising business, do they have to go after more expensive sports content? And that, of course, then can, skew that equation a little bit.
Geetha, everyone's so fixated on the number of subscribers added to the advertising tier in the US and Canada, but they're not providing us those details. Why do you think that's the case? They just want it to stabilize more. They're still building out the strategy. I mean, at some point, especially as they start to not tell us their actual subscriber numbers, they're going to have to give more details.
They are going to have to give more details, but I really think they're looking to build a critical mass here, Scarlett. So they did give us some, scattered data points. We know they have well over 40 million monthly active users. Now, the typical math there is, it's 2 viewers or 2 monthly active users equals 1 subscription. So, people have guesstimated they probably have anywhere from about 19 to 20 million, ad-based subscribers. Again, I think they're playing this very, very carefully. Remember, there are a lot of things that are happening here. They're beefing up their programming to make it more attractive to advertisers. They're also kind of re-engineering their whole ad tech strategy. So they're building their own in-house ad tech, and they're also opening up to third-party partnerships, whether it's with the Trade Desk, whether it's with Google. So that makes more of their inventory available in the marketplace. And they're doing that in conjunction with kind of really ramping up ad revenue. So I think they're looking to build a critical mass before they actually start reporting numbers.
All right. All right. You get something there. I thought I had another video, but no, I did not. Let me share the earnings schedule here. We need earnings. So this is what's going to be coming up next week, guys. This is what's going to be coming up next week. So let's see. Anything important for Monday? I think for the afternoon, after the close, I see SAP, Nucor, I believe, is steel company, if I remember right. Nucor, yes, it's steel. What else? Logitech, kind of important for the NASDAQ, maybe not. Yeah, nothing else really. Yeah, probably only SAP or Logitech might have an effect on the NASDAQ, but I don't think Monday's going to be having anything special. So Tuesday morning, Verizon, GM, 3M, and Raytheon, RTX, ticker RTX for Raytheon might be pretty interesting to see. Also, copper miner, FCX, so Freeport McMoran, FCX, that would be good. And GE. So GE, Lockheed, yes. So these are all nice large cap, blue chip type stocks that you'll see affect the Dow and most of the S&P in the morning. But for the NASDAQ, let's see. Texas Instruments, definitely important for semiconductors. We have Enphase. Yep, that'll be for the solar people. Enphase, you want to see what they say there. Seagate, kind of important. Disk drives, kind of important, but not really. Yeah, nothing else there important. So that's for Tuesday. Now, Wednesday, let's see, before the open, you got Boeing, you got AT&T, ticker symbol T, Coca-Cola, KO. Oh, this is one of my favorites too. So NEE, Next Era Energy. That's going to be good for the utility type stocks. Check it out. I think they do some nuclear energy too, if I'm not mistaken. GE Vernova. So this is what the GE split into for their nuclear side of things. So GEV also going to be good. And TMO, Thermo Fisher Scientific, yes. So if you're doing some laboratory biotech type company, yes, that's a big one. That's a big corporation. TMO. And General Dynamics. So another important one for the military industrial complex. So Boeing is the big one I'll be looking at, and I'll also look at Next Era Energy. So those two definitely very important on my list. Then after the close, we got three big ones that'll affect the NASDAQ. Tesla. No, who can forget Tesla? TSLA. So after the close on Wednesday, LRCX, Lam Research, Semiconductors. Very important. So if it's going to undo the damage of ASML, you got to see LRCX do much better than they did. So it can't be hard. Got the bad news out the way. Hopefully, these next semiconductor companies won't screw it up. You got IBM. So I talked about IBM yesterday, I believe. Yes, IBM. I showed that chart. And it's a nice blue chip. Nowadays, it's very nice. Before it was a dog, but now great. Newmont. So this is for the gold miners. So if you're looking at GDX and GDXU, wait for this to report. It's way too late to buy. Don't buy before earnings, okay? I don't care how much of a gambler you are. You just don't want to do that. If it's going to pop, let it pop, okay? Just watch what it does. If it's going to drop, watch where it drops to, and then decide from there. What's up, Rashu? What's up? And you got ServiceNow. That's a cloud. I think I have an article actually on that. Maybe I'll read it next. QuantumScape, battery company, speculative battery company. Okay, so next week's not so boring after all. There's going to be some of these I'll be watching. So I'll keep this in mind. We'll talk about it next week when these companies come through. All right, United Airlines. I'll talk about that next too. So let me see. I'll talk about ServiceNow article and then go to United Airlines article. So talk a little bit about airline industry. It's because American Airlines, yes, got to watch that for Thursday. Should be important. UPS, ooh, big one. Logistics and transportation. If UPS doesn't do well, some people will use that as a bellwether for the economy. And we have Love, so LUV for Southwest. LUV is the ticker symbol. Anything else? Oh man. Oh, this company's not bad. Tractor Supply Company. So the redneck version of, I guess, Home Depot. I don't know. I mean, Home Depot is kind of, I don't know, whatever. But yeah, it's a pretty good company actually. I haven't looked at their stock in a while, so I'll have to remember to pay attention to this one. TSCO. All right. Anything else? No. Nothing interesting. Thursday after the close, Western Digital. So more memory. Yeah, I think Western Digital is probably the only thing that you probably would pay attention to for the NASDAQ for Thursday. But otherwise, nothing important there. We got Texas Roadhouse, TXRH. If you care about that stock, I don't think I've looked at that stock for a long time either. Oh, yeah. And Friday, usually a boring day. You got Colgate, Palmolive, CL, SAIA, so shipping, another trucking type stock. Yeah, you can watch that one. And Centene, I believe, a CNC, I believe that's a health insurance company. Oh, I forget. But yeah, okay. So outside of Tesla, UPS, LRCX here, Lam Research, you got GE, like two of the versions of GE and Raytheon. Not going to be too much next week. So for some reason, all the big tech guys, they shoved it into Halloween. I really don't understand why they did that. Because if next week is going to be boring, then I'm going to be really, really, really afraid what the stock market is going to do in 2 weeks' time. I mean, that's just too much pressure because you're gonna shove all those company reports right through around the same 2 to 3 day block, and you're just gonna create all kinds of volatility there. It's like this is such a bad idea. So far, October has surprisingly been quite calm. So that gets me nervous. When there's nothing happening and you're getting closer and closer to election, and people are really thinking now that like, okay, the polls, the casino odds for who's gonna win the election is primarily on Donald Trump right now. It's kind of getting fishy because I hate it when people are so sure of an outcome. Because when it flips the script, once they flip the script, you don't want to be around on the wrong side of the trade. So be aware. Don't be rushed. Don't be a rush to buy. We're still in early days. Calm down. Don't get trapped. Don't get trapped. So anyhow, let me stop this sharing the screen. So let me play this video first, and I'll have to remember. And while I'm playing that, I'll try to look for those articles I mentioned earlier. I'm trying to remember if I played this one or not. I might not have. So let me see. I'll play this one first.
How dire of a situation is it for Boeing where they're resorting to job cuts at this moment with a strike still ongoing?
Good morning. Yeah, it's a pretty risky strategy that you're sort of throwing these 17,000 job cuts, 10%, into the middle of an already messy strike. Obviously not something that is looked upon favorably by the unions and the workers. They see this as a threat. Boeing basically trying to some degree, negotiate in public here, saying we might not need all these people who are striking, and business is such that we have to make some tough decisions. We don't know at this point exactly where the hammer will fall. We don't know who will get cut. The company did say on Friday that management, executives, and workers will equally be affected. So there's a sort of a sense of solidarity and sort of common purpose in this. But at the same time, we don't know how much it'll cost. We don't know how long it'll take. So the sort of financials tied into these measures, that's the part that remains unclear. Boeing is due to report earnings on the 23rd of October, so middle of next week, and hopefully we'll find out a little bit more then. But for the time being, the stock is down a bit. People are still sort of digesting what came out late on Friday.
As we move into earnings season, it appears that traders and market participants will be very focused on initial earnings from the banking sector, as their earnings are some of the first to be released each cycle. Certainly the numbers will be important, but of equal importance will be the projections for the economy, lending, and interest rates. Traders will be looking for banks' views on how the economy has been navigating the higher interest rate policy that has been in place for over 2 years to combat inflationary pressures. Will the economy avoid a recession as economic activity has slowed and labor markets come into balance? Will the consumer remain active? Will inflation be a problem moving forward? Additionally, traders will be analyzing how the banks view the Fed policy and the reaction in the Treasury markets. The yield curve has recently come out of the extended inversion. As the yield curve steepens, in theory, this should be good for banks as net margin interest opportunities increase. If the projections indicate sustained growth, low inflation,
I don't know why StreamYard sometimes pauses
and
videos
yields
early.
normalizing, since indicates sustained growth, low inflation, and yields normalizing, it would follow that banks should benefit.
So weird. StreamYard's got to fix this problem. Sometimes it does that, sometimes it doesn't. Really bizarre. And here's another small video. This one might be a little bit harder to understand, so try to follow it.
That the polar opposites are not being priced in. What does that mean for the dispersion of outcomes on where things can go in the bond market?
So there is a very fair dispersion of outcomes here. And I think Nisha brings up a really important point here that sweep versus no sweep matters a lot. We see that when you look at how the markets responded to election outcomes historically. What tends to be most bearish for rates, specifically the long end of the curve, is that sweep outcome. And that's because the party that's in power will tend to be spending more money. This is true for Democrats.
You heard that, right? So remember that article I read at the beginning, the very first one, the populist argument, where a party that gets too much power and has a populist type platform, they will start spending more, and that's bad for rates in the long end of the curve. So that means TLT, those long bonds, they are going to get hit if you get a sweep. A sweep meaning Congress and the president are all in the lockstep on the same party, right? And they have like the majority to pass laws and to tend to do things. Okay, so I mean, I don't know if that actually will. Well, I mean, yeah, if Donald Trump and the Republicans win, like what kind of spending programs would they do, right, compared to the Democrats? I wonder.
Republicans, it's really very important to how the market's going to consider this outcome, is what it means for the fiscal outlook, what it means for supply, and that's why we see the back end feeling that upward pressure. So to us, the more clear way to trade this rather than purely from duration, what matters a lot for the direction of rates to us is the Fed, the economy. The Fed's still looking to be on this cutting trajectory. The better way to trade this fiscal premium that we see in markets is trading swap spreads. So looking at how cheap we see longer term cash treasury yields relative to things like OIS and SOFR.
How do you think about duration, Nisha? Would you buy at these levels, or do you worry that the 10-year yield would be meaningfully higher a year from now?
No, look, I mean, for our clients at Parametric, especially as we know, there are a lot of clients sitting in very short-term instruments, cash, CDs, money market funds. I mean, we are still, going out with the message that this should still be a favorable market for bond investors. And look, I don't think, at least through year end, the Fed necessarily changes course just yet. There is more data that is coming out, from now until the next meeting, another payrolls number, inflation data. But I think if we're assuming that the Fed is still going to want to back to more that neutral rate, more kind of recalibrating rates, I still think you see another 25 basis point cut at each of these meetings. Perhaps the cuts that we're seeing next year might be pared back. But the point being, Shonali, is that for bond investors, this is an opportunity, in our view, to step out of cash and to lock in yields, right? Real yields and inflation-adjusted yields are the highest that we've seen in a very long time. For investors that have been looking for fixed income and allocating to fixed income, I think this is a great opportunity to step out of cash and at least start legging in. Now, from a duration standpoint, I think this is where, you play a little bit of the short to intermediate part of the curve. I do think that, especially as we wait to see election results, you could see more volatility on the long end of the curve. Perhaps this is not a scenario where you go kind of extreme long duration, if you will, but this is still a great time to step out at least a few years and lock in what we think is very attractive yields right now.
So you heard her duration. John was talking about duration several times this past week. It's a common terminology used in bond markets. And if I have time, that's going to be a big part of the lesson today. I don't know if I will have time, though. Okay, so let me get to the articles. That I said I was going to do. So earnings next week will have ServiceNow, and ServiceNow did have some news on Monday, October 14th. ServiceNow, CoreWeave, and others to invest $8.2 billion in UK data centers to fuel AI growth. Enterprise software giant ServiceNow and AI-focused startup CoreWeave, all right, have announced plans to invest billions in the UK. Okay, ServiceNow has said it would invest 1.5 billion in the UK over 5 years. CoreWeave said it would invest 750 million pounds or $978.6 million to support UK demand for artificial intelligence infrastructure. In total, the cloud infrastructure investments from a range of companies amount to £6.3 billion, according to the UK government. All right, let me zoom in here. Enterprise software giant ServiceNow and AI-focused startup CoreWeave announced plans to invest billions of dollars in the UK in a vote of confidence for Prime Minister Keir Starmer as he looks to attract foreign investment. ServiceNow said it would invest $1.5 billion dollars in the UK over the next 5 years. Yeah, we read that. As it grows its UK business, the US-based company plans to expand its UK presence with new office space and grow its staff base beyond the 1,000 people it currently employs. ServiceNow also said it would invest the cash into localizing the processing of data for its large language models, LLMs, artificial intelligence models that rely on vast quantities of training data to be able to understand and generate text like a human. The firm said it would bring NVIDIA GPUs to its data centers based in London and the Welsh city of Newport to support processing of data on its LLMs within the UK. So this will help support domain-specific LLMs for UK clients and governments, ServiceNow said. Policymakers and regulators in Europe have increasingly been calling for so-called AI sovereignty. Didn't I mention that last stream or 2 streams ago? Maybe I did. This refers to the idea that the technologies and data underpinning advanced artificial intelligence systems should be stored within Europe and more accurately reflect the culture and history of Europeans. No, that's funny. Cloud computing firm CoreWeave, meanwhile, which rents out expensive GPUs to developers. You heard that? Rent out. Renting out. Looking to train and run large AI models, said it would invest £750 million to support UK demand for AI infrastructure, its second major investment in the country after announcing a £1 billion commitment in May. Meanwhile, 2 US data center operators also announced plans to invest billions in the UK. One firm, Cyrus One, said it plans to expand its investment in the country to £2.5 billion over the coming years, while another, Cloud HQ, committed to developing a new £1.9 billion data center campus in Didcot, Oxfordshire. Didcot? Didcot? In total, the cloud infrastructure investments amount to £6.3 billion, according to the UK government. Today's drumbeat of investment is a vote of confidence in Britain and our approach to work with business to deliver sustained growth for all. UK Technology Minister Peter Kyle said in a statement Monday, upskilling programs. ServiceNow said it also planned to offer new skills programs in the UK that will reach 240,000 people. The United Kingdom is embracing technology transformation at scale. In this new age of AI, the country continues to be a global leader in driving innovation for the benefit of all its communities. Bill McDermott, ServiceNow's CEO, said in a statement Monday, our investment accelerates the UK's push to put AI to work, empowering people, enriching experiences, and strengthening societal bonds. Together, ServiceNow and our customers across the UK are delivering a future where technology benefits everyone. The announcements were made as part of the International Investment Summit, where UK leader Keir Starmer is set to gather 300 business leaders to encourage foreign investment. ServiceNow, CoreWeave, CyrusOne, and Cloud HQ aren't the only U.S. tech firms betting big on the UK as a global destination for AI innovation. Earlier this year, Salesforce opened its first global AI center in London, a space it's using to facilitate artificial intelligence training and upskilling programs, as well as promote industry collaboration. The AI Center forms part of a $4 billion investment Salesforce committed to making in the UK over 5 years in June last year. Okay. A lot of this AI sovereignty stuff, huh? Everybody wants their own AI, GPU, data center, blah, blah, blah. But did you see that? Did you see that? Something about renting. Renting. So all these people are renting out time on a GPU. You're a developer, or you're someone who wants to run applications dealing with AI, and you're renting space, time, compute time, basically, on servers far from you. That's a good business model. You can charge anyone a subscription on like just like us right now with StreamYards right here, right? I'm sure someone up the chain is charging them more money, and we're gonna have to pay the bill for it, right? There you go. That's how it works, man. Okay, next article. I think I'm gonna switch over to airlines now. If you got sick of AI this and AI that, I did have another one. Actually, since I emphasized that rent, okay, I lied. Here's more AI. If you're not sick enough already, I'll put the link for the other for the other article, and then I'll put the link for this article. Okay, yeah, I lied. My bad. More boring AI talk. If you're not sick enough of it, AI this, AI that. Why Cisco reportedly wants in on CoreWeave's rent a GPU racket. This may help Switchzilla hit $1 billion in AI sales goal by fiscal year 2025. Cisco reportedly plans to throw its weight behind CoreWeave in a deal that would boost its valuation to $23 billion and potentially cement the network giant's place in the rent a GPU outfits cloud. According to a Bloomberg article citing unnamed sources familiar with the matter, the deal comes as CoreWeave CEO Michael Intrader reportedly nears completion of a secondary transaction which would allow existing shareholders and employees to tender $400 to $500 million of their holdings. Investments in CoreWeave reached a fever pitch this year after the Roseland, New Jersey-based startup raised $1.1 billion in a Series C funding round in May and raked in another $7.5 billion in debt financing that same month using its GPU infrastructure as collateral. Cisco's potential investment is by no means surprising, and likely for the same reason that NVIDIA is funding GPU clouds like CoreWeave and Applied Digital. Without data centers, there's nowhere to put their tech. And so even a small investment in a bit barn operator can pay dividends in sales of GPUs and networking kits down the line. It goes without saying that if Cisco is willing to plow significant capital into CoreWeave, they're getting something out of the deal, likely in the form of a commitment to deploy their hardware and software stacks. Winning over CoreWeave would certainly go a long way to helping Switchzilla. I don't know why this paper keeps calling Cisco Switchzilla, but all right. Realize the $1 billion worth of AI product orders by the end of its 2025 fiscal year it's previously projected. It remains to be seen how big a role Cisco's networking kit could play in future CoreWeave compute clusters. That's because NVIDIA's compute architecture heavily favors its InfiniBand network tech, or at least for the compute fabric used to distribute workloads like training jobs across multiple nodes. While Ethernet dominates the data center as a whole, as we previously discussed, this isn't the case in AI compute fabrics, where InfiniBand remains accounting for roughly 90% of deployments. That's not to say InfiniBand is a requirement for using NVIDIA's GPUs at scale. For customers that don't want to maintain multiple network stacks, NVIDIA also offers its Spectrum X line of Ethernet-based switches and super NICs. That's interesting. I forgot that NVIDIA got itself involved in networking. So not only are they providing GPUs, but they also favor certain network technologies to hook them up between each other. I really forgot about that. Yeah. So we got companies that are doing optical transceivers and things like that. Those companies, yeah, I'll have to see which ones are actually helping out with NVIDIA on InfiniBand and all this stuff. I'll make a mental note of that. Ethernet is currently an option. However, just going off CoreWeave's website, its existing data centers are using InfiniBand for the compute fabric. Yeah, okay. Then where does that leave Cisco? Well, even if CoreWeave sticks with InfiniBand for its compute fabric, it still needs networking for management, orchestrations, and storage, which don't require the kind of low latency, low loss qualities InfiniBand commands a premium for. For all we know, CoreWeave could already be using Cisco kits for these tasks. The networking giant declined to discuss its investment plans, and CoreWeave didn't immediately respond to a request for comment. Cisco's equipment could be used as a supplement to InfiniBand as well, given the considerable demand for GPU systems, all of which need to be stitched together using high-speed network fabrics. CoreWeave could opt to reserve InfiniBand for larger training clusters and use Ethernet everywhere else. Over the past year, Cisco has expanded its relationship with NVIDIA in a bid to push Ethernet deeper into AI clusters. Back in February, the networking Goliath rolled out a series of hardware-software platforms designed to support NVIDIA systems, in addition to its speedy custom switch ASICs, which each boasts up to 51.2 terabit per second of bandwidth. Cisco has rolled out a series of reference designs, essentially templates, designed to simplify integrating AI infrastructures into enterprises' existing platforms. Cisco has also extended support for NVIDIA's Bluefield 3 DPUs and Super NICs and AI software platforms in its Nexus Network Management Service. Integration with NVIDIA's Super NICs is particularly interesting, as in theory it will enable customers to achieve InfiniBand-like latency and loss by taking advantage of sophisticated congestion management functionality, a concept we previously explored. While it might seem strange that NVIDIA would welcome a company whose products compete with its own, compatibility with Cisco, Juniper, Arista, yes, Juniper and Arista are another competing. Arista actually is a pretty nice stock. I played it before. It looks like it's still moving up. I'm not sure how good it is long term, but yeah, Arista, I believe the ticker symbol is ANET, ANET. Cisco is SCCO. Cisco is pretty lame, honestly. It's like one of those blue chips that never die, but somehow keeps surviving. Yeah, its stock hasn't gone anywhere since 2019. Yeah, Cisco is pretty bad. ANET, however, Arista, very good. Very good. So it's been going from 70s. So that's the time I got it, around 70s. It's now at 400. I've sold it along the way, so I don't have it anymore. But it's at 400 now, so not bad. Juniper Networks. So I believe that's JNPR. Yes, JNPR. I'm right. Yeah, it's gone nowhere too. Man, it had a huge up move in January, but still, yeah, it hasn't gone anywhere. Really, like it's around the same price it was in 2022. So Juniper, JNPR. Yeah, ANET's the only one. ANET. ANET is kind of like made from a split off of Cisco people that left the company and did their own thing, I think. So, there you go. Let's see. In other words, anything that lets CoreWeave and others buy more GPUs is good for business. All right. Blah, blah, blah. Nothing else there. I think I'm sick and tired of talking about AI. And maybe I'll have to leave the airline stuff for later. Yeah. Let me play this video. Let me play this video. It's about an hour long, so I got to skip around, but it has some important, very important things to talk about the economy that you might as well listen to it. I can find it. So this is by Jeffrey Sherman. He works for the Bond King. The Bond King. Oh, I forgot his name now. Jeffrey Gunlock. Okay, Jeffrey Gunlock, the Bond King. So Jeffrey Sherman works for Jeffrey Gunlock, and he's going to tell you what's up with the macro level stuff.
What I'd like to do is go, as usual, go over the macroeconomic landscape, just talk about where we are kind of in this overall cycle and how we're thinking about it as we go through the rest of the year. And I'd like to remind everyone that, you know, looking at the kind of post-World War II era on trendline growth is that, you know, we did a very good job for many years of having a 3+% growth rate. The challenge is that, you know, post-GFC, you know, once we had the global financial crisis, we really never got back on that trajectory. And you can see here the slope of that dotted line went from the blue dotted line to the red dotted line. But good news is that we're above trend since the GFC, and that includes recuperating from the pandemic experience. You know, when you start to use this rounding, you see that we're about 0.2 trillion ahead of the long-term trend. I remind everyone that that means we're 200 billion above that trend. So that is actually a positive thing. And if you look at what the IMF is scheduled or forecasting going forward, it's essentially along that that red dotted line as well. So the positives about all of this is that, you know, we continue to kind of perform similarly to that post-GFC era. And it's good to see that the economy continues on that trajectory. So to me, what this means, there's just a change in potential for the output for the U.S. economy. And I keep using this chart, and every time I say I don't want to go back as far, and every time I still go back to the 2010 experience. And what I like about this chart just shows kind of the range of estimates and where we actually ended up in terms of GDP growth. And again, this is on a real basis. So it's the annual numbers that we see in that post-GFC world. But really, notice the numbers on the right-hand side of the chart. They're essentially two handles across the board. The good news is that, you know, during 2023, we're forecasted again, I'm sorry, in 2024, apologies there. The forecast there is getting us back to 2.6%, which is above last year's estimate of 2.5. Remember, the estimates will converge to the actual numbers, and is actually, if you look at this, you know, one of the better years of overall growth since the global financial crisis. Obviously, 21 was the rebound from the pandemic, especially after the amount of money we printed out there and injected in the economy. I'll talk about that a bit later. But notice the 2010 experience, that's coming out of the GFC. The 2018, a lot of that was off the tax cuts that got passed in the 2017 experience. And so if you think about where we are overall from an operational standpoint or output, the economy's done very well post-pandemic era. And so again, I just kind of show this chart just to show that there's a lot of range of estimates. You can see here the evolution of 24 with the most forecasted recession in the history of mankind that happened throughout 23 and 24. Now we've kind of moderated. Even in 25, economists are saying, you know what, maybe indeed this is kind of middle of the cycle and that we're not scheduled to fall off a cliff. So all the times we were talking about falling off a cliff, at least from the consensus estimate, it did not seem to transpire. And there is some reason for optimism. And again, this is not actually looking at the output of data. This is an economic surprise. And so what was pretty amazing about during the most forecasted recession ever back in 23 was that the data kept surprising to the upside. And so again, the surprise indices, all they really show you is that where the data is coming through relative to expectations. What you see here too is that all of a sudden, you know, in 24, we were underperforming the expectations. Some of this because those expectations rose, but all of a sudden the data has started to tick up, at least again, relative to expectations. And if you look at this versus the rest of the world, you know, it's doing quite well. And so once again, the US is the place to be. And so part of that is because of something I alluded to was the amount of injection of liquidity that we put into the marketplace and the overall economy starting in 2020. And obviously, some of this was an aberration due to the pandemic. We got addicted to those policies. We did it again in 21. In fact, the creation or the expansion of the monetary base over those 2 years was north of $7 trillion. And you can see that actually we did have some fiscal restraint. It may not feel like it, but actually there was a contraction in the money supply during the 2022 experience. But the bad news is that.
See that huge hump there? You see that huge hump from COVID? Look at all that money printing you did. We're way above that trend line, right? That dotted line. So where do you think that money's going to flow to next? And not only that, but consider all the money printing that we did across the world in different governments. So all that foreign money looking for places to go. I smell a bubble coming, a big bubble, and it's going to be quite nice. Quite nice. So wait for it, guys. Wait for it.
We don't continue to do that. We're expanding that monetary base once again. But if you look here, just like we're looking at the trend line growth in the global economy, or sorry, the U.S. economy, what you can see here is that this is still a meaningful amount above what would be that kind of long-term trend of increasing the monetary base. And so, one, this is some of it is why we had levels of inflation. But secondly, this money found a home. This money didn't just evaporate. We didn't go out and light this money on fire. We put it into transactions. We did things. We traveled. We spent it on services. We speculated on assets. Look at financial assets. It's sitting in those markets. It's sitting in the housing market today. So I won't say that you can always print your way to wealth, and that's usually not a good way of borrowing your way either. But this money does exist today, and it does sit in the system. And so potentially this is something that's helped kind of keep the economy going over these periods of time. Well, where did it come from? Well, it came from the government. And so the good news is that the government is running one of the lowest deficits we've seen since the pandemic. But the bad news is it's still a pretty scary number.
All right. I'm going to go forward a bit here. There. Yeah, let's go. Around. Let's see. I wish StreamYards had a better way of doing this. All right. Around here.
If you look at the amount of interest that is being spent in the budget relative to the revenues, it continues to accelerate. Again, this is still from the 2023 experience, and these expectations are set to go meaningfully higher. And so we'll have to see as policy evolves next year. Obviously, we have an election in less than a month's time, or exactly 4 weeks' time at this point. That, again, may change the path here. But I think most people would prognosticate, irrespective of who's in the White House or who's running Congress, that we're likely to continue to spend. So this remains the elephant in the room. It will continue to be the elephant in the room. You'll hear people in a lot of circles talking about this. But for the time being, it's not that relevant of a conversation because the impacts aren't today's problem. They are the future's problems. Obviously, future problems can become today's problems, but markets are definitely not focused on this. And the bond market will tell you when it's time to focus on that. So,
all right. So again, bond market will tell you when to focus on that. So that graph that he was showing earlier, let's see, try to put it
you'll
back
hear
up
people.
here. This graph is what's the percentage of the federal revenue. So how much money the federal government takes in has to be spent on interest payments to the bonds. You know, if you go out and buy TLT, you get paid, right? 3%. If you're the Bank of Japan or something and you have a bunch of treasuries, the U.S. government has to pay you too. And all those things cost money. So right now with interest rates so high, you're going to have to pay more and more because our debt load is so high. We have to issue a lot of that debt now more than before. So going forward in the future, all the current bonds that are at a higher interest rate will have to be paid off later on. And that's why you see here the percentage of the revenues that are being coming in to the US Treasury will have to be used to pay off that debt. So anyhow, yes. Let me continue on. I think I can continue on here. Okay, let's skip to 15 minutes. How about that?
It's always joked that, well, if you take out commodities, because no one needs food, no one needs energy, let's take out housing because that's not really relevant in most people's lives either. So you live on the streets, you don't consume any commodities, then you have super core inflation. Well, take a look at this. Well, the reason you don't hear about this concept from the Fed anymore is that these numbers aren't supportive to the overall argument. And so I'm going to retire this slide after this presentation day. We won't talk about it again. But the thing is that inflation is still a problem. It's just not as meaningfully problematic as it was. And more importantly, I think what you're seeing is that it's that stickiness of prices or the lack of the Fed allowing there to be deflation in the system that prevents prices from coming down. And so I think the Fed feels comfortable about their inflation objectives. It's moving in the right direction. So on their dual mandate, the key is to focus on the employment component. And that's what the market has been doing for a while. Inflation's somewhat under control. We'll get another print on Thursday of this week to see where the CPI report shakes out for the month of September. But, sorry, it should be August date, I guess. But if you take a look at the labor market, it continues to give you kind of strong data. Now, we know there's been some revisions to the data set, so maybe the numbers are a little lower than we see on the screen here. But you see, irrespective of the time series that you're using, we'll use a household survey or the non-farm payrolls. Both are surveys, by the way. If you take a look at that, well, what you see is that the household survey really hasn't created a lot of jobs over that period. Remember, the household survey just asks if you're employed, so it doesn't pick up multiple job holders. Versus the non-farm, which has had a lot of adjustments. There's been a lot of criticisms about the birth-death models as well, and then that's what's driving a lot of the jobs. But I think we can all agree that the jobs number that came out last Friday and the report spooked the bond market. This idea that everything was well contained, that the labor market was rolling over, the Fed needs to react very quickly. That was really doused by that last report. What to see again? Even Goolsbee that comes out and loves when the farm payrolls are very strong, said, one data point doesn't dictate policy. I agree with that. Let's see if the strength will continue. But there's also been a lot of this kind of idea that the jobs are all part-time jobs versus full-time jobs. And what I show in this chart over the last couple of years is that there was a lot of full-time employment growth during the 2021 experience. We got a fair amount in early 23 as well, but it's really been mixed, whether it's full-time or part-time. Notice these bars, they kind of bounce back and forth. And so when you look into aggregate the economy, we've been adding jobs. Now, the part-time side always gets, it gets a lot of flack. And I like how in the household survey, there is the concept of saying, well, if you're part-time, why? Are you part-time for economic reasons or for non-economic reasons? And so what's always disconcerting is when you see a big spike or an uptrend in the economic reasons, right? That's saying that, you need to be working, you're not able to. Non-economic reason encompasses everything else. And so what you see here is that maybe there's a shift in tastes and preferences. I'm not here to say that we should have a bunch of part-time workers in our economy, but this is a trend that's been underway for the last 60 years. And so when you take a look at that, yes, there was a revision to the estimates. That's why you see that spike in like 90 at the end of 93. But you can see here that there has been this increase in part-time employment across the economy. And so nitpicking it when it's convenient for one's own narrative is not really a good way to think about the economic landscape. But it is pretty important to see that there seems to be people working. There seems to be, again, not a lot of people getting unemployment insurance. Take a look at this slide here. There's two time series here, one with an average. The left-hand axis is the continuing unemployment claims. So what happens is that when someone loses their job, again, this is not a quit, but you lose your job, right? You were terminated or your job was let go. When you file for your unemployment insurance at the state level, you get initial claim. So you're the initial claim. From then on, from the next week, the next set of initial claims are people who are new to that unemployed force. And so the continuing claims are the people that are just sitting out there looking for work, getting this unemployment insurance, but not able to procure a job. And notice how eerily stable that line has been for the last 12 months. Yeah, there was a little bit of an uptrend over the spring to summer months here in those continuing claims. They seem to kind of stabilize in this 1.8 to 1.85 million number. And if you look at the continuing claims, and it's noisier because, I'm sorry, I said continuing. If you look at the initial claims, it's the blue line. That axis is on the right-hand side. You can see there's roughly 225,000 that are coming out of the labor force each month. But if you look at that 1.83 million of continuing, well, that says in about 6 to 7 weeks, you'll get, or at least 7 weeks, you kind of replace that part of the labor force. And so this doesn't seem to be this big conundrum of that people aren't being able to find jobs once they are on this form of unemployment insurance. I like this data, one, because it's not a survey, it's actual data. There are challenges with this, like any government collection agency here. But in general, to me, this kind of signals that there is some stability, or at least this continuity once one loses a job, the ability to find one, let's say, within a couple of months' time. And another way of thinking about this is that, as I showed with the part-time employment force, the labor force has grown over time. And so if you think about this in the context of, let's look at those continuing claims, where they are, and let's compare them to the size of the labor force, you start to get a different picture here. And notice here, too, that this is one of the lowest levels we've seen absent where we were like in that kind of peak employment post-pandemic era. But notice where we were at this level going into the pandemic as well. So looking at the continuing claims as a percentage of the overall labor force is not giving you this radically, dire picture on the labor market in the U.S. And so there seems to be some stability and some continuity out there. This doesn't bode well for the folks that are not working today, but in general, this is something that just trying to think about ways of framing the data that again, maybe paint a different picture than what's getting all the headlines out there today as well. And, this is a favorite chart of the Fed. I was joking with the analysts that put this together. It's like, man, could you make the scale any more distorted to make this look like a negative picture? Because what you find is that there's 8 million jobs available according to the JOLT survey, but there's only 6.8 million people that are looking for work. Man, that sure doesn't look like a 1.2 million person gap in that chart, because it's so distorted by the experience that we had post-pandemic. But look, the job openings rate continues to go down. The hiring rate is going down. The quits rates is going down. So that means there's just much more stability out there. But again, the openings rate, and I saw the SOM piece about being commensurate with, kind of a higher unemployment rate about 10 years ago, has seen the openings and hires rates out there. But these numbers look in the context of at least the last 20 years, they seem to be pretty solid numbers. And so again, I'm not seeing as many cracks in the labor market as people try to look for in the data today. That said, we know labor's fickle. We know it's a lagged indicator. It's one of the last kind of shoes to drop in the economy. I like to always say that companies don't lay people off because they think a recession's coming. They think they're either mired in one, their business is suffering because of that recession, or they have a bad business as well. And they need to essentially kind of restructure that business. So in general, this is something that's still positive. It can obviously turn very quickly in a cycle. It can be hit by exogenous shocks. But for all the criticism out there about the data, it sure seems to be that the labor market is really holding up. Why this is important? If people have jobs, they typically get paid. When you get paid, that means you earn money. When you earn money, you tend to spend some of that money. And that's what drives our economy, my friends. Another thing that we keep hearing a lot about is how bad the non-farm payrolls data is. And again, it's a government source, so is the JOLTS data. So one of the analysts on the team put together something to look at the hires minus the separation. So this is how many people you employ, less how many people leave. Either you let them go or they leave the firm on their own volition. And compare that to non-farm payrolls. And if you take a look here at this chart, and we're not trying to lie with axes here, but if you notice here, the time series seem to be very highly correlated, one. And secondly, they're not giving you much different of a signal. Now, granted, they're both government data sources, but there's been some made about this. So we zoom in over the last few years, and you can see at these time series, they have been a little noisier. The hires versus separations has had a little bit bigger moves in magnitude versus non-farm, but in general, they're roughly in the ballpark of one another. And I think if I told you the economy was creating 200,000 jobs a month or 240,000 jobs a month, you'd say same difference at this point. And so what you're seeing is that both data series are kind of giving you a picture that says maybe there is some truth to these numbers. Yes, in some instances, the birth death model is likely over exaggerating the amount of payrolls out there, but also just in terms of the aggregate number of workers in the economy, it sure looks somewhat reasonable today. Another thing that kind of ticked up was wage growth. We saw that tick up on average hourly earnings in the last report. That's the blue line here. Notice here for a 3.94 kind of wage growth. I thought I saw it round to 4.0. So I'll have to question that data source there on the round there. Maybe it's like 3.946, and that rings to 3.95, which rounds to 4. But anyway, point being is that these are still healthy numbers, right? This is still a wage growth rate that is meaningfully above what we were seeing pre-pandemic, at the pre-pandemic levels. Then you find supervisory employees that are ultimately in the Atlanta Fed. It's not really supervisory, but what it is you actually measure the same person. You ask them what they made last year and what they currently make. And you see that wage growth is a little bit higher as well. And so irrespective of how one slices this today, it sure seems like labor is still doing quite well. And someone's asking me already a question there, asking about the longshoreman settlement and what it may mean for inflation. Well, it means higher wages. You're damned if you do, damned if you don't there. Either you pay the workers and you have that pass through of inflation on that side. You don't pay the workers, we have supply shortages, and all of a sudden we have higher prices too. So it was one of those things where, again, this is the negotiations with labor. Very convenient. They did it about a month or so prior to the election. I thought they would drag it on a little bit farther than they did, but again, it's not over yet either, right? That agreement only goes through, I believe it's to the beginning of January. But so if things are so rosy, why do people feel so bad? Why is the sentiment so bad? And I used this in the previous webcast, and I think this encompasses how people are feeling, because if you take and I've rightfully, or I very methodically picked the start date here, and I didn't do it to cherry pick the data. I just know that the average hour earnings, if you go to the previous slide, notice that big spike we got during the pandemic. It's not that people got a lot of wage increases during the pandemic, right? That's not what happened early in the pandemic. It's that the labor force changed, right? It was the lower end worker that was laid off. Thus, if you look at the average hourly earnings, it went up, right? Because it's a change in composition of the labor force. So what I did is I said, let's just start in July. Let's index it and let's see what cumulative inflation looks like over this period versus cumulative wage growth. And what you see here is that, unfortunately, using average hourly earnings, inflation using headline CPI has outstripped the cumulative progress that people have made on their wages. Now, this is again the aggregate data, and it's using this average hourly number. We did it with the Atlanta Fed number, and they come in neck and neck on each other. They're roughly the same level, or the cumulative inflation is roughly in line with what the wage growth is. But what you see here is that the slope of the lines have changed, where the wage growth has been somewhat constant over this period. You see that the inflation, with it coming down a bit, people are starting to make up the gap a little bit. But this is why people feel so horrible. At least that's my contention. People remember traumatic events. And if you ask someone what the price of something is, they're going to compare it to December of 19. or they're going to compare to some period prior to the pandemic. And so because we've had this surge in inflation, it's what's kind of, I think, weighing on the psyche of folks that feel like they haven't made any progress or they're doing significantly worse than they were. And so, again, obviously, asset owners have done extremely well during this period, right? We talked about financial markets since the pandemic.
Asset owners have done extremely well. So that's it. Stocks, real estate. But everyone else who gets a wage, you feel this crunch, right? That gap between the actual cumulative wage growth versus the CPI, it's spread out pretty far now. And that's what he's alluding to.
We talked about the housing market. If you're an asset owner, you have done quite well over this period. It's the labor that has struggled. And for as much strides we talked about the labor market, when you put it in this context, it sure doesn't look like they've done a lot. But if you look at the savings rate, it has went up a little bit. This was due to some of the revisions.
Yeah, so apparently there are some savings left over, but in general, Americans don't have much savings left. So let's go back to that first chart.
That was
right
really
here.
doused by that last report. What to see?
All right.
Give you kind of strong data.
So hopefully you can probably, if you can zoom in, I can't zoom in on this thing here, but if you see that non-farm payrolls graph at the bottom, total, so non-farms payroll employment total less household employment adjusted, you see that orange graph. Now you see that peak in that graph there. It was around, I guess, 1999, just before the dot-com bubble implosion. Now you see this peak here, right? That's starting to creep up. We're about 3.51 million. So there's a difference between the reporting between the two numbers. So that's why I talked about that article where like it feels like a 94, 95 situation. You got a lot of immigrants coming in, putting them in the labor pool. And then you have all the stimulus starting to percolate up here. So the 94, 95 situation sounds very, very similar. And I would say now it's even worse. We got AI too, so that's a new technological change. So, and it's hyped in a lot more convincing way than the dot-com was. The dot-com internet bubble type stuff was really too far away to be realized. But now with all this spending with the infrastructure and things like that, and all these countries rushing to try to make their own sovereign AI data centers and things, there's a lot of money flowing just to build, So China, its economy was built through infrastructure, actually building roads and high-speed rail and ports. Now, we already got most of our infrastructure right, and it seems like there's a political deadlock here to try to improve or fix what we have pre-existing. But this AI stuff is kind of in people's forefronts, in their minds. So I think it's going to be a bigger political football in the coming days. And I have a feeling that's what's going to spur a lot of this bubble. Yeah. So keep your eyes out. Keep your eyes out. See what the talk of the town is. If they're still talking AI, if they're still trying to keep that in people's minds. And also it affects labor too, right? The strike, the port strike, and the Actors Guild or the Writers Guild, they're all talking about that AI taking their jobs and stuff like that. So I think, yes, it is a priority in people's minds. Man, so this is interesting. Very interesting days indeed. So let me skip ahead to, I think, 34 minutes about here. here.
So when I roll the whole picture together, I still see labor being somewhat intact. I see the economy still firing. I see the consumption still on the service side. And so it makes me question whether or not, we're at the very later end stages of the cycle. Yes, things can still turn. You can still get to where, things could fall apart. If we decide to all save money and we don't want to consume anymore, that can be self-fulfilling in its own right. But right now, it sure feels like as we end 2024, that the U.S. economy is still in a decent spot today. So what does that mean for markets? So I like to start with volatility of markets. I look at volatility of markets as a way of signaling is there stress. So the black line is the one that most people look at. It's equity volatility, or it's AKA the VIX index. Well, when you look at that, it's not really signaling meaningful stress in the market. Yes, it was 22 last Friday. 22 as the close yesterday. Some of that has to do with the rate vol and how things moved around a little bit. Notice that blue line is back to some of the highest levels we've seen all year. That's rate vol. That's what happens when the curve sells off 13 to 24 basis points across the curve. You're going to get some rate volatility over that period. But notice that these indicators don't really seem to be signaling meaningful stress. Yes, rate vol is higher than it used to be when the Fed was out there kind of with its zero interest rate policy, with inflation well contained, rates weren't volatile. But if we rolled this chart back, 25 years, you would see from the cycle from the from the tech crash, let's say in the recession we had in 22 and 23, that recovery until the GFC, you really didn't get this is kind of normalized rate volatility. That's what happens when you're not manipulating interest rates, doing QE, and all these things. And so in general, something to watch again. But the bond market was very negative. The bond market has been extremely pessimistic about the path of interest rates, that they're going to go down. The Fed has to cut hundreds of basis points over the next 6 to 12 months. That's what's been priced in the market at different points throughout this year. And I want to remind everyone that 2.5 weeks ago, the bond market, before we got this jobs report, post-Fed meeting, was saying that there would be 200 basis points of interest rate cuts from the overnight rate for Fed funds rate by June of next year. And from our standpoint, sitting here looking at that has to be a dire situation that gets us those levels. Something has to miss economically. So although prices recalibrated on Friday, we saw a reprice of the bond market. One, it's nicer to see, right? We now have four-handle yields at parts of the Treasury curve once again. But secondly, it just got rid of some of that pessimism that was in the marketplace. So I think rates look a lot fairer today. But again, there's going to be some noise as we have to deal with the labor market as well as the inflation data, and we're not through the woods yet. Performance in the third quarter is very strong. It's been really nice in the two client reviews I've done thus far. It's nice to talk about how good the performance has been across bond markets. What's pretty interesting here is that it's been a fixed rate market in the third quarter. Since the Fed kind of indicated their next path was to cut rates, that they were going to do so, they needed to wait a little bit longer in the data. Fixed rate markets have been moving ahead of the other parts of the curve, and you see this in the third quarter performance. The laggards here still made pretty good money for the bond market. Worst performer at 170 basis points for a quarter. By the way, that annualizes north of 6. I think we'd all take that. And what you see here, it's that fixed rate stuff that did much better. And so in some instances, you have a year's return that was baked into the quarter. In fact, let's look at the year. Year to date, you can see that treasuries, again, were negative going into the third quarter as we saw that rate back up. Remember, rates were kind of low going to the beginning of the year. They rallied in January and spent most of the year selling off. So we had a negative to the first half of the year. But notice what's really done well are the things that have been more speculative assets. The non-agency CMBS market, this was really beaten up last year. The triple Bs are kind of that fulcrum tranche or where some losses will erode into. And so there's been there was pessimism there. So there's been some optimism went throughout the year. The triple C leveraged loan market, right? You look at the high yield market, if we went to triple Cs, those would be some of the best performers as well. Look at EMD, emerging market debt, kind of showcasing how long that's, how well that's been. A lot of that is longer duration than the US market as well. So in general, what you find here is a bond market that's done quite well this year. And you look at credit, this year, you've been rewarded for junkiness. The worst of the quality or the things that did very poorly last year are the ones that have done quite well this year, or the things that did really bad in 22 and took 2 years to recover. But notice the highest quality bonds on the far right-hand side are the least performers. I won't call them worse since they're up almost 3% or so, but obviously owning credit has been a good thing to portfolios. Owning credit's been good, owning rates has been good. Now the question becomes, what do you do at these levels today? And I like to remind people that even though we've had a pretty meaningful rate rally, rates are still elevated from the experience we had in that post-GFC pre-pandemic era. And no matter where you look across the curve, rates are higher than they were at those periods of time. And so, as I mentioned, seeing 4 handles on rates again looks pretty interesting out there. I'm going to skip the inflation break-evens. Bond market doesn't care. We got a little pessimistic there in terms of pricing it. We're back to kind of where we were. I do want to take a second on the dollar, though, because in meetings, I've had a lot of people point out to me that the dollar's declined until that we saw in the last couple of trading days. But the dollar decline, this must be the deficit, the stuff that we're all talking about, how much of the deficit is out there. But it's really just interest rates. And this shows you from this chart. We can use the 10-year. We use the 10-year here. It lines up quite nicely here. You can see in the last couple of years. But as rates have come down, as policy expectations of rate cuts has got accelerated, what that's done, especially as the rest of the world, we're going to converge down lower. What that would to the rest of the world, that kind of equilibrates some of that dollar behavior. And so you can see again with our spike in rates, given what happened last Friday, all of a sudden the dollar pops back up again. So in general, it seems to be a one-way trade. I don't really have a strong view on the dollar today. I think you got to get the interest rate call right at that point, and that's what we'll focus more on than trying to think about the dollar. If you buy a generic index fund, you're back to 450 in yield. If you look at kind of the ETFs out there, they're lower yield because, again, they bought the bonds at higher prices. I'm sorry, they were higher price than they are today in a lot of instances, and thus they don't have the same current yield on them. But if you look and assume par payback, about a 4.5 yield. 4.5 yield doesn't sound horrible to me when thinking about investing over the next couple of years. Looking across various parts of the market, I like to take these next couple slides together, these next 2 slides together, where we look at yields. This is the range of yields over the last 10 years. So the min and max for each of these segments of the market. Notice where we trade today relative to the average of the last 10 years, still relatively elevated. So I hear this a lot from our credit teams, yield buyer, yield buyer, yield buyer. And I say, great, it's you're a yield buyer. People are trying to lock in yields, but also spreads do indeed matter. And so from that standpoint, if I can buy a 10-year treasury at 4%, should I think that 4.9 is great because it's above average on corporate bonds, or does it look rich? And so one way to think about that is to now look at where the spreads rank. And this chart does it slightly differently because we're doing a lot on the same chart. What you show on the vertical axis is the percentile ranking. So higher the number, the cheaper the asset is over the greater the spread you get relative to the last 10 years, or at least on a percentage ranking basis. And then the horizontal axis simply shows you what that spread is. Notice what jumps out here. First of all, IG corporates are at one of the lowest percentile rankings they've been in 10 years. So as I show you in our portfolios, there's a reason we are very underweight those assets. Notice high yield corporates as well now have a very similar outlook. In fact, that spread is inside of 300 basis points, about 285 or so today after today's trading. Look at emerging market corporates. Once again, one of the tightest spreads we've seen in the last 10 years. Just given the deleveraging, the debt service coverage ratios are extremely high, the low coupon on the service of the debt. Same with high yield corporates. If the economy is still doing, if it's going to continue to fire like it has in the last 3 to 6 months, I think corporate spreads, albeit tight, make some level of sense. But when you have the menu of choices and you can find things that offer an above median spread, and again, can get you a meaningful spread out there, it's something you have to take a look at. Now, the bank loan spread's a little distorted because of the triple C market. If you strip out triple Cs, The yield spread's probably more like 350, 375 or so if you pull that cohort out. So it's not as cheap as you see here, but we're using broad indices as well. But notice things like high quality mortgages, whether they're residential, they're commercial rated, either of those still offer pretty significant yield spreads out there relative to history, even the asset-backed markets. So with that, I'm going to finish my prepared remarks and move on to questions. Someone said, when are real interest rates going to begin to decline? They actually have. If you've been paying attention in the last couple of months, call it 3 months, nominal rates are down. And by the way, the inflation rate has been somewhat stable to slightly down, and the nominal rate's been dropping faster than the inflation rate. And so they have started to decline. By the way, I don't root for meaningful declines in real interest rates. If we get paid positive real interest rates, that is a good thing. That means we're protecting purchasing power. Our income is greater than the inflation rate, and thus you're making advances relative to the inflation. So be careful of rooting real interest rates to decline unless you're trying to be an equity investor and telling me, well, that means the multiple can expand, and those things tend to be somewhat correlated, not pari passu or just in lockstep. But in general, I like getting paid for taking bond risk that's above the inflation rate.
So I'll stop there. I mean, that's a lot of bond talk for 15 minutes right there. That was pretty intense. But that last part, he was talking about, like, you don't care about real interest rates, the real interest rates, okay? Real meaning the interest rates you get from a bond minus the inflation rate, okay? That's the real interest rate. That's your actual real return. So he said he didn't like it to go dropping too hard now, too low now, because what would that mean? That would mean stocks would look more attractive. He said equity, okay? Equity is stocks. Equity with multiple expansion. So remember that word, multiple expansion. So remember way back, halfway through this video, I mentioned duration. And most of this week, we talked about duration. So what is the duration of owning a stock versus owning a bond? A bond, you know what the duration is. You have 1 year, 6 months, 3 months, 1 month, 5 year, 7 year, 10 year, 30 year, right? Your mortgages, 30 year, right? 30-year mortgage. That's the duration. And so when you're owning a stock for the long haul investment, when are you going to get a return on that investment? That's your duration. And a stock doesn't really pay any coupon. It's not really riskless, right, compared to a treasury. Of course, you saw over there that you had some 18% returns on some of those bonds, but those aren't really riskless either. They're corporate bonds. And not only that, they're pretty crappily rated at triple Bs and whatever. Those are pretty terrible. I think there was some C bonds on that little graph he was showing earlier. So let me put up this article. Let's see what we got to talk about. And I'll end the 30 minutes on these little articles here, because this is your lesson for the day. This is your lesson for the day. So let's see. I have 1, 2, 3. Let's see if I can get through these. Yeah. This one is from Carson Group. So they got this little blog. Put up the link in the chat. You can review it later. What real interest rates can tell us about equity valuations? The change in the price of a security or index can be broken down into contributions from earnings growth and valuation changes. The S&P 500 is down 19% this year through September 16th. So this is an old article from September 20, 2022. And if you remember those days, those that was getting the 21 to 2022 days, yeah, it was up and then down. It was like the aftershock, I suppose, of low interest rate policies since COVID-19, right? So you got the high in 2021, and then you got the low 2022, the come down, as they would say. So nothing, no drug is free from after effects, right? As they say. So anyhow, and as this chart from JP Morgan illustrates, that is entirely due to falling valuation multiples. Remember that word again, multiples. Earnings growth has been a positive contributor to price return. So you see here this gray line going up here. It says earnings growth, so 5.9%. So it's been going up. So earnings has been going up. So why would the stocks go down? So you see the multiple growth, it's going down. So these stocks have been shedding its price, yet it still has earnings growth. So what changed? What changed? The forward PE ratio for the S&P 500 has fallen from about 21.5 at the end of last year to about 16.5 now, which is not far from its 20-year average of 15.5. So price to earnings ratio, that's what PE means. So that's your multiple, okay? So that means people were willing to pay 21.5 times the earnings of the S&P 500. And then later, even when earnings was still growing at a clip of 5.9%, the price of those stocks in the S&P 500 dropped to a multiple of 16.5. So they were only willing to pay 16.5 times the value of that stock, or in all those stocks combined in the S&P 500. So, and the average is usually 15.5. So that means all that happened was that people were not willing to overpay 21.5 times. They were only willing to overpay 16.5 times. So valuations have fallen sharply and are now closer to 20-year average. So this was back in the September 2022, you see. We just had a little bubble here then. So this is the valuation multiple. So you had a 20-year average of 15.5. So some years you were undervaluing that average, and then some years you were overvalued that average. So now we're back at that average in 2022. We definitely should revisit this chart updated to today. Okay, that's pretty important. So I'll have to put that in my to-do list. Looking ahead, analysts continue to hold S&P 500 earnings estimates steady. Earnings estimates for 2022 are up from the beginning of the year, while 2023 and 2024 estimates are down a bit. Unless the economic outlook turns really bleak, we don't foresee these changing significantly over the next few months. Okay. So I guess these were the estimates they were thinking into 2023 and 2024. Okay. Which leaves us with the question as to what happens with valuations. And for that, we need to look at real interest rates. As go real yields, so go valuations in the opposite direction. Quite often, the S&P 500 earnings yield, which is the inverse of the price to earnings ratio, i.e. the E over P. So this is not the PE, this is now the EP. So the E earnings divided by price gets compared to nominal treasury yields. The idea is that when EP is greater than treasury yields, stocks yield more than bonds, and thus they are quote unquote cheap. and vice versa. The logic is extended to argue that low interest rates allow for a lower EP and thus higher price to earnings or richer valuations. All right. You should read that paragraph a few times. A few times. I think this is a very important concept because as I said, everything as an asset competes with another thing. Okay? So cash competes with gold, competes with bonds, competes with stocks, quote unquote equity, competes with debt, quote unquote bonds, competes with real estate, right? Land, essentially. So a lot of assets that you own all have to be put into a little pie, and how you divide up your money between liquid, illiquid, this, that, you got to figure that out. And that's why when there's competition for gains, for growth, people will switch off between the various asset classes, right? Oh, and don't forget crypto is now a new asset class, right? However, the PE ratio is a real quantity and its inverse EP should be compared to real yields. PE ratios don't have to rise and fall with inflation. Instead, corporate earnings do that. Also, the usual and correct understanding is that as the discount rate falls, the price goes up. However, if nominal yields are falling, it's likely that inflation is also falling, which means the nominal cash flow from equities will also fall. So, lower expected cash flows offset lower discount rates. Over the last 5+ years, real yields or yields on Treasury inflation index securities has seen quite the roller coaster ride. 5-year real yields rose from close to zero at the end of 2016 to above 1% by the end of 2018 when the Fed hit the peak of their last hiking cycle. The Fed, if you remember, went from 0 to 1%. And if you were really cognizant of that time, what happened was that the junk bond market imploded. The stock market then fell just after that. And then in January of 2019, the Fed said, no, we're stopping it. We're not going to raise rates anymore. We stopped QT, quantitative tightening. They shut it down. The only time we got back to raising rates was when? 2021 November announcement. So only realistically it started in 2022. And now this is why at that time the stock market started pulling back all its gains, unwinding those multiples right back down. They turned negative pre-pandemic and went deeper into negative territory in 2021. But this year, the 5-year TIPS yield has surged almost 275 basis points to 1.25%, their highest level since 2009, thanks to a hawkish Fed. So TIPS is a inflation protection type bond. I'm not going to get into that. You guys can go, look it up yourself. What is interesting is that over the last 5+ years, real yields have been very correlated with valuation changes. As the chart below shows, it plots EP against 5-year real yields. Higher real yields have coincided with higher earnings yields, cheaper valuation multiples, and vice versa. So, this chart here, the scatter plot, right here, shows you that if you have a high real yield, people are less likely to overpay for stocks. If you want to see stocks fly high, you want those real yields to go down. Just like what Mr. Sherman was telling you in that video at the end there. He's like, he's a bond guy, okay? I told you, he worked for the Bond King. He works for Jeffrey Gundlach. The Bond King doesn't want competition from stock guys. They want bonds to be the investment of choice. So they're going to look and say, hey, I don't want these multiples here to go up. So I don't want those real interest rate yields to be going down. That's what he was saying, right? That's right. That's right. So this graph shows it. Okay, that's about it for this article. Let's go to the next one. Let's see, this is from Franklin Templeton. Franklin Temple. I don't see a title here that's that okay, I'll talk about this one then. So this is August 22. So it says quick thoughts how duration affects stocks and bonds. All right, yeah, I'll read this one. Market volatility and uncertainty look likely to linger for a while. Stephen Dover examines how to navigate the current environment and how the concept of duration plays a part within fixed income as well as equity investing. Okay, there you go. Yeah, equity investing. All right, let's see. Hopefully, this is the correct one. Economic and political dislocations, recession fears, high inflation, and aggressive monetary policy tightening have roiled markets in 2022, producing one of the worst half-year results for global investors since the early 1970s. We think the most likely outcome for the rest of the year is that the inflation and recession factors unsettling investors will not recede quickly. Even if the worst of the market setbacks are behind us, volatility and uncertainty will likely linger. Notably, volatility in the bond market is unusually higher relative to equities. Inflation and fears about the Federal Reserve's tightening cycle are partially responsible, but so too is the large price impacts associated with rising bond yields from very low starting levels. When traditionally safe fixed income assets are leading the capital markets downward, this leads to questions on how to navigate an environment that has changed markedly from where it was 6 months ago. Okay, so move index is the bond VIX. So VIX is a measure of I think implied 30-day options volatility. Okay, so the move index is an analog of that for the bond market. And I'm not going to explain any further. You can look it up yourself. Maybe one day I'll talk about VIX more because I think that is also an important topic, but not today. The answers depend on individual needs, preferences, and tolerances for risk. But in general, the solutions for many will be found in renewed opportunities in income and portfolio rebalancing. Taking a deeper look at the underlying factors driving asset prices and market volatility, duration is an important concept to consider across asset classes. Duration can be simply defined as the expected holding period of an asset. The longer the duration, the greater the risk. Sensitivity to interest rate changes and hence the ex ante required compensation an investor outright ought to demand. That's why, for example, bonds that mature further in the future typically offer higher yields than those with shorter maturities. So remember that other video, right? We're talking about the implications of the election results on bonds. What were they talking about that was in trouble? They were talking about the longer duration part of the curve, the 30-year treasury yields in particular, right? So that TLT, that's the article I read at the beginning of this whole stream, is going to be weak And that's why if gold over TLT, remember that ratio. If it's continuing to go up, that means gold will outperform. That means something. That means something. There is a structural change now happening when gold is more favored than US Treasury bonds. That says something. And that might say something a lot more than just, your own little lives here. It's actually a global issue because the whole paradigm, the whole dollar dominated world that we live in now could be turning. So keep that in mind. Moreover, to the extent that payoffs from a longer duration asset arrive much faster, as is the case with longer maturity bonds or growth stocks. Read that again. Moreover, to the extent that payoffs from a long duration asset arrive much later, as is the case with longer maturity bonds or growth stocks. Growth stocks. So what did I talk about yesterday? I talked about XBI, those biotech companies. Those are very risky. And I said, if we are at the precipice of starting a new bubble here, you want to see those type of stocks go up because those people are putting in money into things with long duration that are way riskier than a long duration bond. So what does that tell you? That means they're greedy. They're starting to get greedy. They rather take the risk on those growth stocks because all those little pharmaceutical trash stocks, they all could easily go to zero. But all these people are willing to throw down their chips on the table and place them to bet on those growth stocks rather than on something secure like a bond. Then that tells you something's up. Something's up. So watch that growth sector. It's those small caps. Okay. Their prices will be more sensitive to changes in interest rates and returns over risk-free assets. Okay, guys. Duration risk, not just for fixed income. While most investors typically associate duration with fixed income, its relationship to stocks is also relevant. For instance, when investors pay high prices for growing companies that are unprofitable, just like those biotech stocks that make no profit, that only promise you future growth when their drug gets FDA approval, right? So these companies that are unprofitable today, they are presuming those companies will eventually earn enough to justify higher valuations. In effect, they are partaking in future, not present profits and dividends. It follows that the conditions that favor long duration are often the same for growth stocks and bonds. Above all, the presence of low or falling interest rates. In 2022, interest rates have risen as markets anticipate significant monetary policy tightening to combat high inflation. Unsurprisingly, longer duration bonds and growth stocks have fared poorly. Against this backdrop of duration underperformance and rising volatility, it is not surprising that growth stocks have also underperformed, particularly relative to value stocks. Okay, value stocks being things like Coca-Cola, ConocoPhillips. What other value stocks are there? I forget some of them now. Yeah, but they tend to be boring, and they don't have to be big companies like the ones I just mentioned. They can also be small cap value stocks too. So, but they'll be more risky than the large cap value stocks for sure. So, blah blah blah. I don't think I need to read any more of this. No, 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 no. This is more. Yeah, I think that gave you an idea. This article is a bit long here. Yeah, they're talking about Coca-Cola down here too, so I mentioned Coca-Cola. Yeah. Okay, let me read this paragraph. Looking at the duration of equities is more important than ever. Naturally, dynamic rebalancing requires continuous assessment of market prospects, above all for Fed policy, inflation, and growth. To the extent that inflation may soon peak and growth slows, extending duration makes sense, even more so if coupled with income derived from shorter duration notes and bonds. So, what they're telling you here is that it's time to rotate out into growth, duration, more duration. So that means those growth stocks, I guess. So, and long bonds. So they're saying like, okay, buy XBI, buy TLT, just because they think inflation will peak. So remember, this was the mentality of late 2022. So this was written in August 2022. So people were planning ahead, waiting for the peak of the interest rates in bonds. Yeah, so this guy, that combination may be preferable to taking credit risk, in my view. Using free cash flow as a proxy for bond yields, duration explains the year's underperformance of last year's best performers, the FANG M group of Facebook, Apple, Alphabet, Netflix, Google, and Microsoft in the S&P 500 index, which have a duration much higher than the rest of the index shown in figure 5. Okay. So I haven't talked about free cash flow. I think I'll have to make another note of this. So I'll have to go back in this video and look at all the notes I put in my mind. But free cash flow is how they evaluate many of those high flying Magnificent Seven stocks, like Tesla and whatever now, and the FANG M, which includes Netflix. We got rid of Netflix off that Magnificent Seven. We replaced Netflix with Nvidia now. But yes, they look primarily at the free cash flow. So a lot of software companies too that have nothing. A lot of those like Snapchat. Like if you don't have high subscriber counts, you don't have the free cash flow going. I mean, that's the problem with Snapchat. Yeah, it's only driven mostly by subscriber counts. If you don't have good free cash flow, it's easy for those stocks to get whooped at like 20%, 30% haircuts when it has a bad earnings report. So that's why you don't want to play with those during earnings. But yes, the big boys though, they have that nice buffer. They got the free cash flow. So you could have an Amazon, right, that doesn't make a profit, but if they got that cash flow, they don't care. So Amazon only made a profit only recently, right? For most of its existence, it didn't make a profit. But because it had good free cash flow, people were willing to pay multiples on that company, because in the future it will be profitable and it will be dominant. That's what the price was going up was based on. Okay, I think that's enough. That's enough now. Now we can get to this article here. Let me see if I gave you a link to that one. So yes, I did. So now we'll go to this last one. So it's just made it to 3 hours. So this will be the last one to talk today. Here's the link. You can see it on the screen too. Understanding multiple expansion. While it's important to be prudent and reasonable with growth expectations, zoom in. Okay, I can't. It is also good to remember that small cap stocks can produce phenomenal gains. We're talking about the home runs that turn $10,000 into $1 million, producing the kind of windfall that changes lives and creates investing legends. And while there are many factors that go into what makes this happen, the most crucial point, the pang of regret we've all felt when hearing about these stocks, is finding them before anyone else. There are many excellent resources that can get you started on this journey. So here comes the pitch, right? This includes a great book by Chris Meyer titled 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. Our approach includes a lot of the aspects Meyer talks about, expanding on them with our own proven and unique style. Okay, okay. Can sell me something? Let's go. Finding a rapidly growing company early is an important part of what's needed for a multi-bagger. But another critical element to multi-baggers is multiple expansion. Right there. You got the multiples. Those multiples. This is where the value or multiple prescribed to a business, be it price to earnings. So here we go. Price to earnings, the PE ratio, EV to earnings, price to sales, etc., expands as the company continues to grow in size. And it's about understanding what drives this multiple expansion. For instance, when you see a stock's value going from 5 to 20 times earnings, this represents a 4x of the multiple. If fundamentals haven't changed, this means for whatever reason, people have valued it 4 times higher. But if fundamentals have changed, the earnings tripled, and the multiple has expanded from 5 times earnings to 20 times. This combination of earnings growth and multiple expansion means the stock's value increased 12 times. This happens more often than you may think, but you must know where to find these opportunities. All right? So there you go. You can read all this little ad here, but I think that gives you an idea because that's what I was discussing the first article, right? There's a earnings which goes up, which is the fundamentals, but then there's what people are willing to pay, and that's your multiples. And then when you combine them together, you get the expansion. So what I contend to you guys is that you can see this through the chart before it happens. That's our goal. We're here to try to look for patterns in the chart. The big boys, those investors that are more professional than us, have already done the homework. And you're going to try to look for clues as to when those multiple expansions and earnings expansions start happening. And when you jump in, you're jumping in at the right time when it's just the train is about to leave. That's it. That's what we're trying to do with the Wyckoff stuff. So you should do your homework. I gave you that homework with the Wyckoff, and I'll put it again in the chat. So you guys always remember to do it. And we'll see you next time, next week. Maybe I'll do a stream this weekend. I'm not sure yet. Might be a sneak preview of what I plan to do with scanning for stocks, automated scanning, and things like that. If we get there, and we should. I mean, I think that's what we should be there by November, because then things will get very hot, and it will get too cumbersome for me just to go over stocks manually with you guys. I want something where it automatically scans, finds the right stocks. I have the list ready made. I just send them out, in a quick update every day. If things get really crazy and the stock market goes wild, we're in early days now. You see some things get wild. We saw lithium, we see uranium, we see some small caps. So definitely like hymns, and yes, there will be more coming, a lot more. Oh, and Bitcoin, those crypto miners, right? I see the potential there. I see that multiple expansion coming up. All right, guys, I'll see you. Good night. Good night. Oh, and before I forget, remember, we got to get the pot for the Halloween contest. We got about 500 something dollars. Let me see the banner scroll. Where is it? 555. There you go. Let me put it up on chat. So yeah, send a Cash App, PayPal to Portia, right there. All the instructions right there. Get it. See the banner scrolling. Get her that money. I'll match the money. We're gonna have some fun for Halloween. All right. And hey, if any of those girls wins, hey, you know what? They could start investing with that money. Because if the stock market goes wild for Halloween, ooh boy, you gotta have some good things to buy. Buy some Boeing, buy some Intel with that cash, buy some Leap options. Come on. Come on. That's the way you make it. That's your multiple expansion. That's how you get rich, guys. All right, see ya.